referral, whether it's through an agreement, whether it's written or oral, or just through a pattern of practice over time. That I know here living in Denver that if I give a certain amount of title business to this title company, I'm going to get to go to a Bronco game on their dime a couple times a year. That would be a violation of RESPA because we're settlement service providers. I'm sending them business. I don't do any work for them other than refer business to them, and they're giving me something of value in return. That is the violation, right? We can't have any kind of agreement or understanding for the referral of business, even if it's through a pattern or practice established over time. I don't have an agreement with them. No, but how many years in a row have you gone to Broncos games with their tickets because you give them business? Oh, no, 14. Oh, well, that's established a pattern of practice, all right? We can't split fees between ourselves. Oh, you know what, I'll just charge a little more and I'll split the extra with you. Nope, I can't offer you kickbacks. The more I make, the more I'm going to kick you back. The more deals you give me, the more I'm going to give you a kickback, a little something for the effort. No, thank you. That's a violation of RESPA. What we've got here is a gray area, markups. All right, markups are a unilateral increase of one provider service by another provider. Example, I'm a lender. The lenders, we usually collect credit and appraisal for the credit bureau and the appraisal that we order, and we collect the money from the borrower, we put it in our trust account, and then we pay the bill. The borrower doesn't pay it directly, and they pay it up front. They don't pay it through closing, mostly. All right. So if I was to order an appraisal, and the appraiser says, yeah, that's going to be $500, and I'm like, all right, Mr. Borrower, that appraisal is going to be $650. Yeah, man, I know it. Appraisals are going up, aren't they? Yeah, $650. So write a check out to Skippy's Mortgage Company for $650. Thank you. I'm going to put that in my trust account. When I get billed from the appraiser, I'll take care of that for you. But the appraiser told me it was $500. Yeah. The appraiser doesn't know anything about it. I just marked up or upcharge somebody else's fee. The appraiser didn't offer it. They're not involved in it. They have nothing to do with it. Well, this went to the Supreme Court in 2012, and the Supreme Court says, based on the way, sorry, CFPB, based on the way we interpret RESPA and the way it's written, if that fee is not split or shared, it's not a violation of RESPA. So the controversy between markups, if it's not being split or shared, it's not a violation of RESPA per the Supreme Court. Now, there are other things that they may say it may violate, like it's an unearned fee, it's an unfair, deceptive act or practice, telling your borrower it's $500, $600 when it's really $500. There's other reasons, but is it a violation of RESPA? Per the Supreme Court, a markup, unless it's split, is not a violation of RESPA. We're going to learn about affiliated business arrangements. I have ownership in my local title company. I have ownership in my buddy's insurance business. And when I refer borrowers to these companies that I have an affiliated business interest in, I must disclose to the borrower that, hey, I own 11% of this company, that my company will have a financial return possibly because of it, and you don't have to use that company, but I'm referring you to them because they're my peeps, and I know they're going to do a great job. There are a lot of ABAs out there that are legitimate, so we'll go into that in a minute, how that works and what we have to do, but then we'll hear more about, especially in ethics on Wednesday, more about sham affiliated business arrangements, which are, no, that's just a way to mark up the fee and make extra money for controlling a service. That's a violation, and we're going to fine you and we're going to shut you down. That's what a sham ABA is, and we'll define that. And we're also going to hear all week about what we call borrower credit. All right. So historically, we used to have something that was called yield spread premium that we could use to enhance our income on loans. If I'm a mortgage lender, or more, especially a mortgage broker, and I look at my rate sheet and I'm like, wow, I could give this borrower a really good rate at 3.75%. Or I could sell them 4 1/8%, and the lender's going to pay me 2 points of the loan amount, 2% of the loan amount back to me as a yield spread premium. I'm giving them a higher rate, so they're getting a higher yield, so they're willing to pay me money to deliver higher yields. And we used to charge the borrower a loan fee and collect the yield spread premium, and I would just double, triple, quadruple my income, and I'd get paid from both entities, and I'd put that yield spread in my pocket. New rules say no. You can't give your borrower a higher rate just so you can make a whole lot more money. You can offer your borrower a higher rate if you take that yield spread premium and give it completely as a credit to the borrower towards their closing cost on this transaction. So now yield spread is called borrower credit. All right, a lot of stuff coming at you. Borrower credit's going to come up a number more times this week. So you don't 100% get it. You're only 92% sure. I promise you, we'll get it figured out because it comes up a few more times. All right, so these are just basic definitions under RESPA. All right, so we're going to have definitions on a lot of the regulations that we talk about. Then we're going to come back and we're going to talk about the different disclosures we're required to give to our borrowers. Why, what they say, and when is a big part of disclosure, so we're going to discuss that. So RESPA requires that we give what's called a loan estimate. Previously, until October last year, it was known as the good faith estimate for many years. There's now something called a closing disclosure. Up until October of last year, for about 30, 40 years, it had been called the HUD-1. So you'll see at the end, I'm sorry, I have some allergies and it's bugging me, and I can't stop itching my face. I really apologize. It's annoying to me too. We're going to get to those when we get to another section later today, because it's been put into the TILA RESPA integrated disclosure rule, what we call the TRID. We used to have a good faith and a HUD-1, and we used to do what was called a truth in lending disclosure under the Truth in Lending Act. And we sent this one out, and we sent this one out up front, and we sent the HUD-1, and we sent another TIL disclosure at the end. Well, they've integrated them, and we no longer do a good faith estimate and a TIL disclosure. We do what's called a loan estimate. All right, we're going to go through those in detail back later today when we're in the Truth in Lending Act. So there are still disclosures required under RESPA, but we find it under TILA because it's TRID, TILA RESPA integrated disclosures. We're going to define and talk about the settlement cost booklet, the mortgage servicing disclosure, and the ABA. Those are the other plus mini servicing disclosures after the loan closes. So the first one we're going to talk about there is this, what we call the special information booklet, or your home loan toolkit. See where it says that in that paragraph there on page 8? We can refer to it by either one. We used to call it the HUD settlement cost booklet, but HUD's not in charge of things anymore. CFPB is primarily, so now it's called the special information booklet or your home loan toolkit. A couple things that we need to know about this is that typically, you see it's called a booklet. Well, it's required that it's given in a standalone format. We can't include it in the middle of a bunch of other papers. So the fact that we turn it into a booklet makes it really difficult not to stand out. So it's got to be a standalone document, and it's required after completion of a loan application for a purchase transaction. The very first sentence under the special information booklet, you want to highlight that. When is it required we give the borrowers a settlement cost booklet? Every time it's a purchase. Well, this is a refinance. Then you don't have to do it. Most of us do, but you don't have to. It's required on a purchase. Also, if there are numerous, well, let's get to that. So what it is, it's a booklet that we give to borrowers when they are buying residential real estate. It explains the settlement process, lets them know that all the terms of the loan are negotiable, that they can shop for closing services, how RESPA protects them, and also warns them that, hey, if you lie, cheat or steal, commit fraud, you could be fined. You could also go to jail. All right, RESPA settlement cost booklet. It's available online, and we're very limited in the changes we as creditors can make to that. There's some flexibility. If there are multiple borrowers, such as spouses, only one disclosure is necessary and can be provided to any one of the borrowers on the transaction. If there's 4 people buying a house, we don't have to send out 4 booklets. We have to send out 1 booklet. All right, that's one thing. So purchases only 1 booklet has to go out. All right, we can recreate it in different languages. We can personalize it and put our company name, our personal name, including, as long as we put our NMLS unique identifying numbers on there and other required information. We can do it in Spanish, we can do it in Portuguese, we can do it in the Baltic languages. As long as it contains the information as prescribed by the CFPB, we can make those type of changes to the booklet, and that's about it. So the special information booklet or your home loan toolkit, it's required on purchase transactions only. It's put in booklet form because it's required to be a standalone document, And we only have to send out one no matter how many borrowers are on the transaction. All right. Now we have the affiliated. At the bottom of that page, there's a difference between a booklet if we're doing a HELOC. This is the first time. We'll see it later. What you should know about home equity lines of credit. If a borrower is applying for a HELOC, we give them that booklet. Not the settlement cost booklet, but the what you need to know. All right. Both sets of regulations are not required on refinances or second mortgages or reverse mortgages. Now, if the second mortgage is a HELOC, an open-ended line of credit, then we do send them what you need to know about HELOCs. All right. ABAs, affiliated business arrangement disclosure. If we refer an applicant to an affiliated business that my company has common ownership, all right, I work for Big Mortgage Inc., and we're owned by a big builder, and we have big title company, we have big builder, and we have big mortgage company, and we have big insurance agency, and I refer my borrowers to any settlement provider that is affiliated by ownership, we must disclose. All right? We refer to an applicant to an ABA for any service, we must disclose the arrangement. And when is it? See that in the very second sentence up there? At the time of referral. This is a unique delivery system. Everything else at application, like the special information booklet, it's due 3 business days after completion of a loan application on a purchase. Almost all upfront documents are due within 3 business days of application. This one is due at the time you make the referral. So if you make the referral the day you're taking the application face-to-face, you want to give them that ABA disclosure right then and there. If I'm talking to a borrower on the phone and go on the application over the internet and the phone, and I say, oh yeah, we've got this great title company, and I'm in California, so I'm using an escrow company, this is who you should use, and they go, great. As soon as I hang up, I need to send them their disclosures at the time of referral. A little trickeration, at the time of referral. It's going to describe the arrangement and the percentage of ownership that the referring party has in the other party, or vice versa. Indicate that the referral may result in a financial benefit for the referring party, the company, not for the originator individually, but for the company. Estimate the cost that could be charged for that service, and advise the borrower they are not required to use who were referred to and other providers are available. Caveat, exception. Note that lenders can require the use of an attorney, an appraiser, or a credit reporting agency. So I like to write ACA. ACA. When can we tell a borrower they have to use one of our providers? When it's the appraiser, the credit bureau, or an attorney in certain attorney states. Right? Borrowers never get to choose their appraisal. So if I have my own appraisal firm or an interest in an appraisal firm, I can refer them to them, and I can make you use them because a borrower doesn't get to choose those things. Credit bureaus, same thing, and some real estate closing attorneys, some states, the lender chooses the attorney. All right. So when can we make a borrower use our affiliated business services? Well, in general, the answer is no, unless it's ACA, appraiser, credit, and or attorney. Okay. Affiliated business arrangement, ABA, at the time of referral. Then there's more disclosures related to servicing. All right, so a lot of you newbies, there's different layers in the mortgage industry. All right, and one layer that has value is called the value of servicing. All right, so and servicing is the function of who collects the payment from the borrower, who scrapes off the money off the top that we're collecting for taxes and insurance or mortgage insurance, what we call an escrow account. A borrower's payments, their mortgage payment's $1,200 a month, but they send in $1,600 a month. Well, because we want $280 a month for 1/12 of your annual real estate taxes, we're taking $74 a month for your homeowner's insurance, so we can pay it every year for you on your behalf to make sure you keep your home insured, and we're collecting $114 a month for mortgage insurance. and that's called an escrow account. That might not have added up right, but you got where I'm going with this, right? And we scrape, the servicer takes that off the top and puts it in a little savings account called the borrower's escrow account. And when it's time to pay their mortgage insurance, when it's time to pay the insurance bill for the next year or the real estate taxes for the next 6 months, that's where we take the money and pay it on the borrower's behalf. Many mortgages require that we escrow for taxes, insurance, and mortgage insurance if we're having any. All right? So that's what a servicer does. And then they take the money that's for the actual mortgage payment and they send that to the actual owner of the loan. A lot of big servicing entities aren't mortgage companies and they're not lenders, they're servicing entities. All right? And then some mortgage companies have their own servicing department, and a lot of big banks also service their own loans, all right, because there's a value in it. So some mortgage companies say, no, we're going to sell your servicing off because it's like winning the lottery. The lottery's worth $300 million, but if you want it all today, you're going to get a check for $120 million. Well, servicing's the same way. It's worth a lot of money over the life of the loan, but as a lender, we're like, you know what? We don't do enough loans. We don't have a big enough department. We don't want to deal with all that servicing, so we're just going to sell off the servicing. It's a commodity. All right, so we have to disclose on our closing disclosure, does the lender intend to service or does not intend to service the loan? All right, so those are one of the disclosures. So we have to first of all say, do we intend to service or not intend to service your loans? Yes or no. That's part of our closing disclosure. And then there's certain rules about establishing that escrow account. When we close the loan, all right, well, we're going to have to pay your taxes in October, and we're closing here in July, so we need to collect 5 additional months of taxes. Your taxes are, $3,600 a year. All right, $300 a month times 5. We're going to collect $1,500 when we close to put in your escrow account, so in October we have enough money to pay your taxes. We're going to collect a couple more months worth of homeowners insurance. We're going to pay your full year plus 2 months, because when we get billed for your insurance next June, we want to make sure we have enough money in your escrow to pay that insurance on your behalf. That is called the initial escrow statement. We're initially going to set up your escrow with this much money for these reasons, and it says due 45 days from settlement. Typically, it's given at settlement. It's now part of our closing disclosure. We show on our closing disclosure how much money is being collected to establish that borrower's little savings or escrow account so we can pay these items on their behalf. And that's a function of the servicer will escrow, and they are there to account for the escrow and to make sure we have enough money to pay our escrowed amounts and we pay them on time. All right? And then every year thereafter, as long as we have an escrow account, the servicer is required to send out an annual accounting of your escrow statement. We got this much money in, we paid this much money for your taxes, we paid this much money for paying your insurances, and ooh, look, we've got $400 more than we need to. Here's a refund of your escrow account. We over-collected. We're going to lower your payment $47 a month, and we're going to refund the $400 over and above what we don't need, because that's the reason for the annual escrow account statement, is to prevent the lender from overcharging the borrower for escrows. It's the borrower's money, and if you have more than you need to pay what you're supposed to pay, then give it back to them. Give it back to them. So every year we're going to get an annual escrow account statement showing what went in, what went out, and they could lower that payment if we collected too much. What happens if they didn't collect enough, right? So in 2005, I lived in Orlando, Florida, and we didn't have one hurricane. No, we didn't get 2 hurricanes that summer. In about a 6-week period, we had 3 hurricanes go through Central Florida. How much do you think my homeowner's insurance went up in the next year? 5%, 15%, 200%, right? Insurance went through the roof for everybody in the entire area because there were billions of dollars in losses and damage. So what happened to my escrow account? I didn't have enough money in my escrow account because my insurance was way more than it used to be, so the borrower had to say, well, the lender had to say, servicer, Whoa, we don't have enough money. We're going to raise your payment $87 a month to make up for the money we don't have and to collect enough money for next year. So that's what we do. We account for that escrow, and we try to get it even every year to make sure we're collecting the amount. If we're under, we got to raise that payment. If we're over, we got to refund the money. Anything over $50 over our allotted buffer, we have to refund and then lower the payment to try to get that to balance. And that's why we give an annual escrow account statement. All right. Servicing is a commodity, and a lot of us that have had mortgages and millions of borrowers are making their payments to ABC Mortgage, and all of a sudden they say, yeah, don't pay us anymore. We sold the rights to your loan to XYZ Mortgage, and that's called a transfer of servicing. All right. So when servicing is transferred, the old servicer must, or the new servicer must give them a new escrow account in 60 days. Hey, we got your loan in from ABC, and this is how much we got for your escrow, and this is how much we're collecting. So there's a new escrow account required. But there's also a, at the bottom of page 9, a transfer required. If we transfer the servicing, it's called the 15-day goodbye letter. 15 days before ABC transfers or sells that servicing to XYZ, they have to send a notice to every borrower saying that's in that batch of transfers that, hey, we're not going to be your servicer anymore. Please do not send any more payments to us or to this address or to this account number. Thank you very much. You will be hearing shortly from your new servicer. And that's the 15 days before the transfer, we send out the goodbye letter. All right. Then I send all my loans to XYZ that's in that batch of servicing, and then XYZ has 15 days from receiving that servicing to send out the, hi there, we're your new servicer. Here's your coupon book, here's your address, here's your new account number. Nothing's going to change on your loan. Of course, we do account for your escrows and change that annually, but your mortgage is what it is, so nothing can change except for who you pay. All right, so we just transferred servicing. We did a 15-day goodbye letter from this one that's not going to be the servicer anymore, and the new servicer has to send out the 15-day hello letter saying, we're your new servicer. All right, and if there's any mistakes made in applying or sending the payments to the wrong place for an area of a time of 60 days for our borrower, they're protected from late fees, and they're protected from us reporting them as late to the credit bureaus for 60 days starting with the goodbye letter. All right, now if they don't make a payment to anybody, they're late. They're going to pay a late fee, and they're going to get reported as late. But if they paid it to the old one when it should have went to the new one, or they paid it to the new one with the old company's name and account number on it, and they couldn't figure out where to apply it and took them forever, still, no late fee, no late charge, no late payment reported to the bureaus during the 60-day period of transfer. Okay, well, I can't share that information, Lacey. Thank you for sharing it with me, but I'm not allowed to share information about knowledge on the test. There are a lot of things that are really important, and that's something, everything that we talk about could be on the test, all right? All right, that's our first break. I'll talk about that in a minute, what our rules are for helping you understand the test, all right? 10-minute break, 10 minutes, top of the hour. Be right back here, and we're getting right back at it, all right? See you back in 10. right, we are back. We are back. All right, Nancy, the computer challenge that happens. I've had an update start in the middle of me trying to teach before, and that would be of this presentation in PowerPoint. No, this is a copyrighted PowerPoint presentation. There's nothing on the PowerPoint that is not in your book, all right? But no, because of the copyright, and apparently things didn't work out so well at times when the PowerPoint's been given out, Training Pro does not release the PowerPoint, all right? There are some review slides at the end of the first couple of sections that you know, that are really good. You know, sometimes if there's something you need to get a copy of, there's ways to figure out how to make sure you get the information that you want, right? All right, but no, you will not be sent a copy of that. So that's disclosures related to escrows and transferring of servicing, right? We're under RESPA. RESPA covers a few things. One of the things they cover is servicing rules and also the rules for escrow, all right? Section 6 of RESPA. All right, we'll let you guys know. We don't check in every time. We'll let you know when we do check in what we need from you. All right, there's always information, personal information from you that we'll ask for, like your date of birth and things of that sort, right? So if we don't ask for anything, there's no check-in required. All right, we don't do it every hour. We do it some hours. Some hours. So that's what that is. Disclosures related to escrows. So Section 8, let's start with that. Section 8 of escrow, of RESPA are prohibited practices for referral fees and fee splitting. All right, Section 8A and 8B of RESPA have things to do with referring, just flat out referral fees, or the other one has to do kickbacks or a portion of the fee. I'll split the fee with you. I'll give you a kickback. The more I make, the more I'll give you. I'll give you $100 for every referral. Either one, it is prohibited under RESPA between settlement service provider. All right, referrals, regulation says that is a violation. So there's a lot of settlement service providers, right? A lot of us are partner, and it's natural for us to want to do business with people that we know are going to get the job done and are going to provide great service to our borrowers. Unfortunately, there are people that just say, I'll use you, what are you going to pay me? Well, I got somebody else that's paying me $500. How much are you going to pay me to send you a loan? No thank you. No thank you. All right? No fee splitting, no exchanging anything of value. Thing of value is broadly defined, all right? And the definition there again at 11, all those, you know, cash, gift cards, right? And there's no nominal, there's no $5 rule. If it's just $10, oh, it's under $25, it's okay. No, it's technically a violation of RESPA. A $10 Starbucks gift card is a thing of value. If somebody didn't do work to earn a Starbucks gift card, then, and they are a settlement service provider that you are doing business with or you are hoping to do business with, that could be considered an inducement to use you. No things of value for referrals. No illegal or agreement or any kind of understanding that I do this, quid pro quo, if I keep doing this, you're going to keep doing that. We don't have to speak it. We know that's the way it is, right? That's also a violation of RESPA. Give you a little acronym here. The word is tow, like you're going to call a tow truck, T-O-W. You might want to write that down because T, if I say the realtor referred business to the escrow company, the title agent, and the mortgage lender, and the title company paid for their entry into a golf tournament, and the mortgage guy did this or that, who's in violation of RESPA? Well, here's the question you want to ask whenever there's maybe a violation. T, was there a thing of value? Thing of value, and that's defined as cash, tickets, special deals, special considerations, lottery tickets, right? Anything of value. Was there a thing of value that was offered to another settlement service provider, and did they accept? Offered and accepted. If so, W, was there any work done to earn that thing of value? Did they do any work to earn that fee, those tickets, that computer, that iPad? Those are things of value. Did you earn it, or did you get it just because we're doing business together? And that tells you, if I offer it, I'm violating RESPA. If you accept it, you're violating RESPA. TOW. Is there a thing of value that's been offered and or accepted, and was there any work done to earn that fee? That defines who's in violation there. And through our little practice test today at the end, we're going to have those questions. All right, and there's a lot more in the big practice test. You guys are all going to be given the answers to, and you have the test. It's in your email now. So I'll go ahead and mention that. At a break or at lunch, there is the first attachment. I think it's the first attachment of all the attachments to the email that you're using to log into the class. There are practice questions. Practice questions. There's 4 packets, so it's a big file. There's 90 questions on today. There's 35 questions over tomorrow morning. There's 40 questions over tomorrow afternoon, and there's 30 questions over Wednesday morning, or something like that. And they're all in one packet, and they're called practice questions, not discussion review. Those are different questions for the very end on Wednesday. So we're going to need those. At the last half hour of the program today is when you need them, so we got plenty of time. But on your break, on your lunch, look for them, print them out. You're going to need them all week, so have them available. All right. Prohibited practices, splitting any fee or any referral or any inducement for referrals is a violation. And then we have affiliated agreements, affiliated business arrangements, which are legal, and then we have sham affiliated business arrangements, which means we've kind of created a shell company. We've got a name and a business card, but is it really a standalone company doing the services it's supposed to do with its own office, with its own employees? In ethics, we're going to have a little more detail on this. Or is it truly, are they a bona fide provider of services, or is it a sham? Just a way for me to collect referral fees. Oh, let's start a little title company, and we'll do it in name only. This happened in Michigan. Nancy, we're good. We don't need anything to check in. We'll let you know when we need to check in. We checked in the first hour. If there's a message from the moderator, which is in green, saying it's time to check in, then we need to check in. And I'll always call it out as well. Let you know, hey guys, we're checking in with your height in centimeters, and I will call that out. It's really not going to be your height in centimeters. Anybody know that? Anyways, just a little funny thing. 197. However, anyways, we will ask for pertinent information from you when it's time to check in, and that, just a hint, it's not going to be your date of birth next time. We did that the first time, all right? Or is it? Or is it? All right? So a sham is a way that, like, my processor is my escrow officer, and I have a phone number and a business card, but I don't have a separate office. I'm only doing business through myself. I'm not going out and trying to get business for the rest of the world. I don't have control of my own business affairs. That would be a sham, and that would be a major violation of RESPA. All right, so that's what we determined by a sham, and we'll see Wednesday, especially in ethics, we'll hit that again. All right, sham. Servicing rules. All right, so after the loan closes, if it's a residential mortgage for personal, family, or household use, there are servicing practices in the residential world. All right, and there are new rules, especially after the systematic breakdown we had in our industry in 9, 10, 11, with all these defaults and all these foreclosures, and these servicers had no idea the storm that was coming, and they were completely unprepared to handle it, and they handled it poorly, and they gave zero customer service, and they foreclosed on people they didn't have the right to, or they tried to, or they told them you're going to be fined, and the next week the other guy goes, if I don't get your money tomorrow, we're foreclosing right away. Well, he said, and so we have all these breakdowns in servicing, so they came up with some new servicing rules. One of the things we're going to see small exceptions for small providers, and the first exception we have is a small servicing provider. All right. There's servicing rules. New rules took effect in 2014 that aim to fulfill the goals to regard to servicing mortgages. And that was what? To facilitate error resolution, timely disbursement from your escrow accounts. If you got money to pay their escrows, pay them on time. Don't be late. Charge your borrower a late fee for not paying their taxes on time when you had the money to pay their taxes. That's your responsibility, Mr. Servicer. All right. Dispersing escrows, providing guidelines when we make or force place insurance, etc. So Reg X defines service and servicing as an individual entity that's responsible for service of federally related mortgage loans. Lenders, banks that make loans and service them, a lot of lenders then make loans and what we call service release. We're going to release the servicing to somebody else. You pay me this much, it's worth this much, you pay me this much, and I'm out of it forever. I'll take my money today, thank you very much. A lot of it's service release. Bigger companies, service, just depends, all right? But if you're a small servicer, you get some exemptions to some of these rules, and that's defined as anyone that services less than 5,000 loans, for all of which the servicer is a nonprofit entity. The creditor is a nonprofit. So if we're doing nonprofit servicing under 5,000, you get to not play by all the same rules. Other than that, everybody else, also a housing finance agency. I'm in Colorado. We have CHAFA, the Colorado Housing Finance Agency. They have low down payment, first time buyer, grant programs. I was in California for years, in Florida for years. Every state basically has a housing finance agency they're exempt from servicing rules as well. They do it a little different. All right. So what are the servicing rules we're going to talk about? In 2014, they said, you know what, servicers, you have to provide accurately, timely disclosure to your borrowers. If they complain, you have to investigate. 5,000 in total. 5,000 in total. There's no per year on servicing. You get a 30-year mortgage, you could be servicing that loan for 30 years. So when we talk about the number of loans being serviced, that's how many they're servicing. All right. Loans closed a year, originated a year. We originate a loan and close it in a year. That's a defined number. Servicing is how many you have that you're servicing at this point. Okay, Jeffrey? So providing accurately, timely disclosures to borrowers. If they complain, they say, we have a complaint, you have to investigate it, you have to respond when they ask you questions. All right. Whoever you're servicing for, you must give them accurate information. The owners or the assignees of the actual mortgage, not the servicer, they must get accurate information. All right. If there's a foreclosure proceedings, you must submit information requested during the foreclosure, identify, communicate with successors of interest, oversee, review service providers, timely transfer of information and documents when it's time to transfer, and then always retain certain documents for 1 year after the loan is paid off or it was transferred. You have rules that we have to follow. So that's just a quick overview of what some of the issues were with servicing, and now we have new rules regarding what you have to do. All right. Borrowers don't have any choice whatsoever in who services their loan, and it kind of came down to being like they're like the post office was and still is mostly. It's like you don't have a choice. I don't have to give you good customer service because you're not a customer. You are a customer, but you don't have any choice. You can't say, you know what, I'm sick of you, ABC, I want to transfer my servicing somewhere else. You don't have that option. So when things got bad, customer service was out the window, and it was not a very pretty sight. So they came in and said, you know what, be the kinder, gentler servicing entities that you need to be. Borrowers don't have a choice. You still need to treat them like they matter and that they have rights, and we're giving them more rights. Here's a list of them. Right? They also, for escrowing, we have to pay the escrows on time or before, and once a loan is paid off, refinanced, the house is sold, or you pay a loan off in full, any money that's in that escrow account is the borrower's money that you're holding on their behalf. That's what escrow is, and you've got to return that money in 20 days. So those of us that are going to be doing loans, we're going to do a refinance of a borrower who has a loan with an escrow account, and we're putting him in a new loan with an escrow account as well. And when we close that new loan, we need to collect 5 months worth of taxes and 2 months worth of insurance and 3 months worth of home or PMI maybe. But they've got money in their escrow account now, and you can let them know that we're going to put that money up right now, and when you get your loan closed off, within 20 days you're going to get a check And a borrower can check at any time what their escrow balance is. You're going to get a check for that amount. That's your money that will be refunded to you within 20 days of paying off that loan. So I used to call it a swap of funds. Yeah, you're going to finance a little more on your mortgage or pay cash because you're going to get that refund right back here, and it's very similar in the amount. Okay? Obligations related to escrow. All right, if we think that the servicer's made a mistake on our loan, charged us a late fee we shouldn't have got, misapplied a payment, we have to send in a qualified written request to a specific address that they must provide us with. If they get a QWI, a qualified written request, we must respond as a servicer within 5 days. We don't have to give you an answer. We have to say, we got your request, and we'll be looking into it. You've got 5 days to tell them that, and then you've got, depending on the scenario, typically 30 to 45 days to figure out what's going on. So you respond to the request in 5 days. You can't charge a fee or anything as a condition of responding. And then once we have a dispute or request, you cannot provide adverse information to a consumer credit reporting agency for 60 days if there has been an error, or they tell you that you think there error until you determine is there or isn't there an error. So it kind of puts some things in hold and puts the responsibilities on the servicer to acknowledge and then find, fix, or tell us why no, we aren't wrong and we're going to leave it as is because of this and this and that. All right. Timing requirements responding to errors vary based on the circumstances. That's why I say 30 to 45, because it varies based on what the request is for or what the issue is. All right. We don't really go into those. Error resolution. Forced placed insurance. All right, if we have a borrower who doesn't have an escrow account typically, and their insurance is up July 31st, we need a new policy, and we don't have it, we're going to start sending them notices like earlier this month or maybe last month. Hey, your insurance is coming due, and we need you to renew your insurance because we don't want to have this home uninsured for 1 day, because that's the day that house that we have a $497,000 mortgage on is going to get struck by lightning and burned down, so we will never let it be uninsured. Please send us your insurance information. Please, please, please. We ask, we ask, we ask. We don't get it. Here it is, the 25th. The policy expires on the 31st, and the lender says, we will write our own insurance policy and we will that's forced place. You didn't get it, I'm going to write my own through my own company or something like that, and we're going to cover your home. And it may be a lot more expensive than what you can get an insurance policy for, but that's what it costs for me to do it. Now, we cannot charge for forced place insurance unless there's a reasonable basis to say you don't have insurance. We've asked 15 times, you haven't gotten it to us, so we're going to add it. We can't over-insure. If we say that you need a loss coverage or this much, we can't write an insurance policy for this much and charge you outrageously for it. Well, we forced it. We wanted to triple insure our house. No, you can't do that. But that's what forced placed insurances are. All right. So, and then if the borrower comes back and says, oh, you wrote insurance on me, man, I was traveling the world. I was gone for 90 days and I was off the grid. Sorry about that. But no, I've had insurance. I switched to BIF. And BIF Insurance has it, and here's proof that I've had insurance effective since July 31st, then they would have to cancel the forced place insurance and refund the money of the insurance because you proved you actually had it. All right, so those are some of the forced placed insurance rules. All right, then we get into servicer delinquency and foreclosure prevention efforts. Excuse me. New servicing rules provide for a kinder, gentler servicing world. Right? You go back 10 years ago, 20 years ago, you're late. You're 2 months late. Either send me 2 payments or we're going to file a notice of default if you get 3 payments down. You're 3 payments down. Here's a notice of default. You got to bring all the money in and cure it in the next 90 days or we're going to foreclose. And it could happen just like that. Well, after the whole mortgage collapse and the real estate market collapse and the millions of borrowers that went into default and then some were pulled out of default and didn't go into foreclosure. Plenty did go to foreclosure, short sales, right, etc. They came up with the new kinder, gentler servicing rules. Basically, if a borrower gets behind, it requires a servicer attempt early intervention, assistance, or loss mitigation. In other words, maybe we can modify or change the loan for you. So if a borrower gets 36 days late, we have to send them a notice going, oh, little buddy, are you okay over there? Your payment's 36 days late. you need some help? Can you afford the payment? Are you going to send it in? What's going on? Here's a number of somebody you can talk to. Here's a point of contact. Here's who we are. This is me and my team. Here's 3 people that will work and know what's going on in your loan. Here's our phone number. Here's our email address. Continuity of contact, right? So I'm not going to talk to you with Joe one day, and then 3 weeks later you're talking to Bill, and Bill tells you something completely different. Well, Joe said this. Well, you know, Joe's an idiot, and he's not with us anymore. And that happened. I paraphrase, but things like that. So now we have continuity of contact, and we offer, if there's an opportunity for us to mitigate your loan, maybe we can modify it for you. We have to tell you how to apply to modify, apply to short sale, how it's going to be reviewed, what the process is. So those are a lot of the new changes in our kindler, gentler world. All right. Continuity contact, provide accurate information on options that are available, identify other options that they're eligible for, identify the documents that we need to get from the borrower to apply for the modification. I need tax returns, I need bank statements, I need this, I need that. Whatever it is, it goes through that in detail. All right. One thing I want to stress is, like somebody just gave me something about, you know, make sure you know the 15 days disclosures, or the timing of disclosures. Timing of disclosures is important. All right. I can't tell you that it is or isn't going to be on the test because I don't know. All right. That person's test is going to be a different test than what you and you and you and you get. There's thousands of questions that they pull from for a 125 question test. And I don't know what's going to be on the test because I have to certify that I don't teach to the test, and I don't go out and find a way to sneak in and take the test on a regular basis so I know what's on my test, right? We've got 20 hours worth of material. There's like 40 hours worth of stuff in this book. So I do my best to cover the most important aspects of what I think is the glaring flashes of this is important stuff to know from teaching this class for a while. All right. There are sections of the book that I'm not going to go into great detail on. Right. I'm not going to read the bottom of 14 and 15 and go through all the different things about servicing, what they have to do. But you need to read through that. And you need to look through little gems that might think, oh, okay, I'm going to try to remember that. Right. I don't read the book. You would hate me if I did. Right. You don't need me if it's reading the book. And there are sections that I will not cover in great detail because I just don't have the time. So when it comes time for you to study and you're looking through something, you go, oh, I don't remember this. That's key to slow down and read it. Make sure you do remember it next time you come across it. Read through it, pick out some gems from it, okay? All right, so don't know if it's going to be on the test, so please don't ask because I don't know, honestly, all right? But that's how I need to handle that, okay? So, servicer mitigations. Fines and penalties, etc. So Section 8 violations, which is the whole referral fees, kickbacks, agreements or understanding, any of that, Section 8A and B, referrals and kickbacks, fee splitting, you can go to jail for a year. You can pay a $10,000 fine up to Section 8 violations of RESPA. Section 6 violations, Section 6, so in there 8, prohibits kickbacks, referrals. 6, loan servicing. All these loan servicing rules we talked about are found in Section 6 of RESPA. Those fines and penalties can be liable for additional penalties up to $2,000. In class actions, we may not exceed $2,000 for each member, and the total may not exceed $1 million or 1% of the servicer's net worth. We're going to see this net worth and 1% or 500,000 number a lot. All right, and then right in there, under Section 6, Section 10 of RESPA is about escrows, paying the escrows on time, accounting annually to prevent the lender from overcharging to an annual account escrow. All right. It also covers when we collect money from our borrowers up front for like credit and appraisal. That's collecting money to pay for something else. So we don't put that money in our regular bank account as a company, or definitely as an individual. Never accept individual monies for that. We must establish and put that in our company's escrow or trust account. We have to account for other people's money. That's what escrow is. So we can't commingle it. We can't not pay the creditor and the appraiser and keep the borrower's money when we collected money for credit and appraisal. You know what? Let the credit and appraiser sue me. I'm just not going to pay it. I need this $400. Right? So those are what Section 10, right in there underneath 8 and 6, put Section 10, escrow information. It used to be out there in the book in some ways, so I just want to make sure we know that Section 10 is all about us handling our borrower's monies, whether it's upfront or through the servicing process where we're escrowing for our borrowers. Escrow. RESPA, the Real Estate Settlement Procedures Act, also known as Regulation X, RESPEX. Okay? That's RESPA. So, what does RESPA stand for? This is where we fill in the blanks, all right? This is, and again, if I get you guys to nod your head and participate, I see better results from people who participate in class than those who sit back and are a little too cool for school, right? So this is where you would type in, and nobody's typing unless I'm not, sometimes I'm on a delay. What does RESPA stand for? The Real Estate Blankety Blank Act. There, settlement, the RESPA has a P, not a D, Robert, or whoever said that. Rachel, it's not settlement disclosures. It's RESPA. It's settlement procedures. Procedures. And it covers settlement service providers. All right. The two new disclosures. We used to have a good faith and a HUD-1. Now it's known as the loan estimate and the what? What do we do at the end? We don't do a HUD-1 anymore. We do a closing. That's right, guys. A closing disclosure. Those are the two big important disclosures about cost we'll go through later today. All right? And disclosures of an affiliated business arrangement are made when? Immediately upon referral. Not at application, not before closing, not within 72 minutes. Immediately upon referral. It could be the day of application. It could be 5 days before closing. We just referred you to a homeowner's insurance agent that we have an ABA with because I don't have insurance from you yet. Immediately upon referral. All right? RESPA. Next regulation. Little thing called the ECOA. Equal Credit Opportunity Act. ECOA. I didn't set my alarm, I don't think. Let me make sure I do that so we don't blow through the next break. I know I need it. ECOA. So sorry about that. A long story for a long night. ECOA was enacted in 1974. All right. The main reason we created ECOA was to eliminate discriminatory treatment of credit applicants. All right? We want to promote and make credit available to all worthy applicants, regardless of race, color, religion, sex, age, marital status, that you receive public assistance, or you've got protection for yourself under the Consumer Credit Protection Act. Those are the protected classes. You cannot use that information or make a decision in any way, shape, or form with any of that information playing a part. All right? ECOA was initially created and brought forth in 1970s, early 70s, to protect women from discriminatory treatment. All right, and prior to ECOA in 1974, if you're a woman and you wanted to go into your local car dealer and buy a car and get a loan, they could look at you and go, "Oh, aren't you cute, darling? Well, do you have a boyfriend or your dad or an uncle or somebody that would co-sign with you?" We don't make loans to girls, really. Come on, it's 1956. You're a girl, right? That was something that happened. Anybody ever see the show Mad Men, right, in the 60s? Were women treated the same as men? Not so much. Also, you could go in as a married couple. You want to buy a house? How old are you? How old are you kids? You guys gonna have any kids? Because yeah, we're not gonna count your income, young lady, because we kind of think you're gonna have some babies and quit working and be a mommy, because that's what women do in 1949, 61, whatever. Before ECOA, we had serious discrimination and women were treated unfairly. So it was it was created or originally proposed to protect women against these type of these discriminatory acts. And then while they're in the middle of it, they go, wow, you know, there's some other people that get discriminated against too. So let's include race, color, religion, sex, marital status, age, unless you're too young to enter into a contract. If you're not 18, big deal. That we can discriminate. You can't go into a contract. We can't do a loan for you. If you're 86 and you want to apply for a 30-year mortgage, be my guest, Mr. 86-year-old. Let me see your credit. Let me see income. Let me see your assets. Yes, we will do a 30-year loan on an 86 or a 92-year-old borrower if they qualify based on guidelines. That age has nothing to do with it. ECOA, Equal Credit Opportunity Act. Who's in charge? The CFPB. How serious are they about stamping out discrimination in lending? Oh, there's a special office inside of the new special agency that's overseeing all of our worlds in finance, and it's called the Office of Fair Lending and Equal Opportunity, which is a special office inside the CFPB. So it's a big deal. It's muy importante. It's known as Regulation B, as in you better be fair and treat everyone the same. Regulation B is ECOA. Be fair, treat them all the same. The only thing we discriminated against is income, assets, credit, property condition. We don't discriminate against property, just the value, what it's worth. CFPB's Office of Fair Lending is in charge. We'll see the FTC have conjunction oversight on a number of issues, and it's typically when there's advertising involved, we got to FTC make sure we're putting our fair housing and fair lending notices and letting people know what their rights are. So there's some FTC, but primarily CFPB oversight on ECOA. All right. So what loans are covered under ECOA? Well, it covers any transaction where the extension of credit by a person meaning a company, a corporation, an LLC, a partnership, or me or you, who regularly extends, renews, or continues credit. So the term person, if it doesn't make sense, well, what person does that? We use the term company, by a company who regularly extends, renews. Oh, that person, because corporations are people too. So said the Supreme Court a few years back, right? So anybody who regularly extends, renews, or continues credit as in the course of business is covered under ECOA. All right. So RESPA's Real Estate Settlement Procedures Act for personal, family, household use on residential real estate. ECOA applies to business, commercial. You want to get a small business loan for your business? You want to get a loan for your farm or buy a tractor for your agriculture product or something like that? You need a loan to get all your dental equipment. ECOA covers all types of credit, not only for personal but also for business, commercial, agricultural use, not only for mortgages but car loans, credit cards, business loans, equipment loans, etc., all covered under ECOA. All right, ECOA. Definitions. ECOA says if we take an adverse action means what? It means a borrower applied for credit and we either said no credit for you, or yeah, you asked for this and we're going to give you something substantially different. We took an action that was averse to what you asked for. In most cases in our world it means we're denying their credit. So if we take a denial, we have to send out certain information and explain to them why we are not giving them what they asked for. Adverse action notice. All right. To discriminate means to what? Treat one person differently because of factors that have nothing to do with their credit worthiness. All right. So I can't treat a married couple different than an unmarried couple. Has nothing to do with whether they can pay the loan or not. I can't treat a single person different than a married person. Has nothing to do with it. I can't treat a man different than a woman, but that has nothing to do with their credit worthiness. That would be a discriminatory act. Discouragement, anything that we either say or put in writing in form of on-hold scripts, advertising, or just conversations with borrowers that would discourage them from applying for credit with us is a violation. Yeah, you're getting ready to retire pretty soon. We probably want to wait till you retire and we can see what all your retirement looks like. No, that's a discouragement. It's just like a pregnant woman. If a woman's 8 months pregnant and she works and she's on her job, we can't ask, what are you going to do? You're going to go back to work after you have your baby? If she's working at the time, if an 82-year-old person is working at the time, whether it's being a greeter at Walmart or still running their business, whatever it is, we can't ask, well, when are you going to retire? Or we don't want to do your loan until after you have the baby, or until that would be a discouragement. Can't do it. Prohibited basis. We are prohibited from basing our credit choices on race, color, religion, national origin, sex, marital status, or age, as long as they're old enough. The fact that all or part of the income comes from public assistance, food stamps, aid for dependent children, welfare, other public assistance, Social Security, disability. There's other types of public assistance. We can't say, yeah, you get public assistance, no credit card for you. Or they filed for protection under the Consumer Credit Protection Act, which I've seen once in thousands of transactions and not in years. But that would be no prohibited. So the protected classes, they're the ones who are protected from discrimination. We are prohibited from basing our decisions on anything that are in the protected classes. Same group, as you notice, right? How do we make sure that lenders, all types of lenders, want to make sure that our employees, different branches, different parts of our companies are doing things the right way per ECOA? We send in undercovers, self-testers. We're going to send in self-testers. We're going to send them in one couple that looks like this. They have the same credit, income, and asset base as another couple, but they look like this, and they're not married, and they look a little bit different, of a different ethnicity, and they are married. Then we're going to see if they aren't treated the same way. We're going to send in a man, like a regular male that looks like this and this race, and we're going to send in a female, same basic information, but different sex, different gender, or different ethnicity, and see how they're treated. And that's how we self-test, and we make sure we're doing things the right way. And then, so who we send in undercover, we call those boys and girls testers. We send in undercover testers to self-test. And then what we find through our testing, we must show that we've taken corrective action. Wow, this one branch, they were really some crazy people. They really treated her completely different than him. He got better loan choices than this woman did. This couple got shown better products and got more attention, and they charged this person a higher rate and fee than they charged these other people. That's a violation of ECOA. And A, we're going to come in and institute some training programs. B, you right here, Mr. Loan Officer, that did that, you're fired. You're blatantly discriminating. We're not going to put up with that. That is a form of correction action. I suspended, I fired, I imparted a training program. I took action when I noticed that what my testers encountered was a violation or could lead to violations of ECOA. And that's what self-testing, testers, and the corrective actions are all about. If I do get brought up on ECOA violations a year from now, and I'm going to come in and I'm going to say, look, I've done 9 different self-tests. Here's what we did. Here's what we found. Here's the corrective action we took. I understand I'm liable for my employees' actions, but I'm doing my best here to do what I can do. And they're going to look and go, well, actually, you are. So we're not going to punch you in the neck. We're only going to slap you on the wrist, possibly. That's the purpose behind self-testing, is to monitor ourselves and to make sure we're doing what we can to do it the right way. ECOA requires a lot of different disclosures as well. All right. First thing says notice of action taken. Highlight the first sentence there. Within 30 days of a loan or credit application, lenders must notify consumers in writing of action taken. From 30 days from application receipt, the borrower must know the status of their loan application within 30 days. Now, that action taken could be an approval. It could be a notice of an incomplete application. Hey, we've had your loan for 30 days. I asked for updated bank statements and your 2015 tax returns with all schedules attached, and we don't have them yet, so I can't proceed any further. Your application is incomplete. Or we send an adverse action. Your loan has been turned down for inconsistent income history and excessive debt to your income. We give them a reason and we turn them down. So doesn't matter what it is, approved, denied, not ready yet, don't have enough information yet. 30 days. When do we notify our borrower of the status? Within 30 days. All right. Valuation disclosures. Effective January 18th of 2014, we creditors are required to give loan applicants a copy of any appraisal that was done on any first mortgages. So we have to give them a copy of an appraiser, either immediately upon approval, upon receipt. We get the appraisal from the appraiser, we want to turn around and email it to the borrower the same day, or within 3 days prior to close, consummation of their loan, whichever sooner. Now, it doesn't say it here, but there is also a notice that we give to our borrowers that we've used for years, and it used to, and the ECOA rule used to be, if a borrower wants a copy of the appraisal, give it to them. So we have a notice that we give within 3 days of application that says you have the right to receive a copy of your appraisal. I don't know why it's not in here, but it comes up later. You have a right to receive a copy of your appraisal. And then the new law starting 2 years ago says we have to give them a copy. So it should have rendered that you have a right to receive a copy notice obsolete, but it hasn't yet. We still tell them they have a right to receive a copy when in fact we must give them a copy. All right, there's not a screen for this. I'm going to go back for just a second on page 17 on the top second paragraph at the top, or the first new paragraph. ECOA addresses discriminatory practice such as redlining. Redlining occurs when creditors refuse to make loans in certain areas of town. In other words, it's called redlining because the good old boys at the bank would have a city map on their wall, and they'd draw red circles around certain neighborhoods that we don't, hey boys, we don't lend in these neighborhoods. They're poor, they got low credit, they don't make a lot of money, they don't speak English like I like, whatever. Whatever the reason is, we cannot pick and choose or say we don't lend in that zip code, we don't lend across those tracks over there. That's called redlining, and ECOA established rules to eliminate redlining. All right. And then in the 90s, when we started having subprime and high-cost loans, we had lenders started doing something that we have deemed to be called reverse redlining. That's where they actually target poor credit risk neighborhoods to go in and put these people in predatory loans. We're going to go in there, oh, these people, they don't have good credit, they don't make a lot of money, they're pretty naive when it comes to credit. We're going to go in there and we are going to, boom, we are going to kill them. We're going to go in there and refinance their loan, and then we're going to refinance it again and again and again, and we're just going to keep taking advantage of them. We're not helping them. It's not reverse redlining if you go in and you say, hey, I've got low-income loans, I'm going to help you clean your credit. You know, my mission is to serve you. That's not reverse redlining. When my mission is to take advantage of poor credit risk neighborhoods, that's called predatory lending or reverse redlining. You know, I'm going into an area that 30, 50 years ago we would have said, don't lend in here. Now I'm saying, guys, target this stuff. We can make a killing. They'll never see us coming. They don't understand it. They don't get it. That's reverse redlining. All right. So valuation disclosures, and then there's a disclosure regarding monitoring purposes. All right, for you newbies out there, when we take a loan application, section 10 of our loan application, we ask our borrowers to give us what their race, their ethnicity, and what gender they are. All right, there's a federal law that we'll learn about later called the HMDA, the Home Mortgage Disclosure Act. And HMDA requires that mortgage lenders report certain facts on every mortgage loan application taken in the country. And 3 of those facts are race, ethnicity, and gender. So we give them a notice from ECOA saying, oh, by the way, there's mortgage lenders who are going to ask you questions that you don't think they should ask you. And they're asking you because they have to. Now, the borrower doesn't have to tell us. They can say, I don't want to give you that information. I'm like, that's your right. I'm going to check the box here. I do not wish to furnish the information. Then it's my responsibility as the originator to look at you and for me to check the boxes what I think you are. So I'm going to determine your race, your ethnicity, and your gender for you if they refuse to give it to us. It's the only part of the application that's actually voluntary: race, ethnicity, and gender. And if they wish not to furnish it, it's our responsibility to make an observation visually and or by using surname, is how it's worded, to determine what race, ethnicity, and gender they are. All right, so we give them a disclosure explaining we don't use this information to make decisions, but this is how. How do we know that millennials are the lowest rate of homeownership of any of the last generations? Through HMDA data. How do we know that the census tract over here on the other side of downtown, known as 5 Points, is, that 42% of the homeowners are African American? From HMDA data. How do we know that? All that type of information, any of those statistics that we have to talk to or that we hear about and that we utilize, all come from our HMDA data. And part of the HMDA data says we ask them their race, ethnicity, and gender, and it's voluntary on their behalf. But we give them a notice under ECOA explaining no credit card company, no car loan place, anybody else is ever going to ask those questions. But we are. ECOA says we are prohibited in credit transactions for making unlawful inquiries. Marital status. Wait a minute. Don't we ask if a borrower is married or unmarried? Wait, we do. Lenders ask marital status. Why do lenders for residential real estate get to ask marital status? Because we have a lien. We have a mortgage or a deed of trust that has to be perfected. And I need to know if you're a married man or unmarried man or a married woman. And I need to know if you're married and you're buying that on your own, what's the status of your spouse? If I'm in a community property state like California, as soon as I close on that house, it's her property as well. And if I'm not checking the wife or the husband that's not going on title because he's got judgments and tax liens and all these other issues, that can affect my property and my ability for the lien. Also, that spouse in other states that aren't community property may still have rights to that property, and they need to be aware of it. So I need to know in Florida that if you're a married person buying it without your spouse, that spouse has to sign an acknowledgement that you're getting a house with a mortgage that they're not on. That's a state law. So there's reasons why we need marital status. We also ask sex, ECOA. We don't ask anything about childbearing or rearing. Well, I see you already have 2 kids. You're going to have some more kids? How are you going to afford those kids? Are you going to keep working if you have more kids? That would all be unlawful inquiries. Race, color, other than HMDA. We don't ask religion, national origin. It says ethnic, Latino, Hispanic, not, or, different questions like that, but no national origin. We do ask age to validate credit report and things. I don't know why we get that exception, but we do ask age or date of birth on our application. And we can't ask questions to discriminate regarding consumer credit protection or public assistance. Now, if they want to apply for a loan and they get public assistance and we need that public assistance to get them to qualify for the loan, then we're going to ask for it. Also, if they receive child support or alimony, we can't discriminate against that. Now, we can ask them to prove that that they've gotten it for the last year and that it should continue based on certain factors. So we have to prove that it's happening, but we can't discriminate if it is happening from that. All right, so we can't refuse consider public assistance. We can't make any different rules for women of childbearing age. We can't make different rules for people that are getting ready to retire, pension benefits, nor alimony or child support. Okay? Wow, that was a quick hour. Next break, 10-minute break, 10 minutes. See you back here in 10. No, penalties for $5,000 a day. If there's a pattern or practice of misconduct, up to $25,000 a day. Not 5 up to 25. That's not what it says. It says up to $5,000 per day of ECOA. If it's a pattern or practice, in other words, this is your normal course of business, discriminating, then it can be up to $25,000 instead of 5. And I'm assuming per day, even though it doesn't say that. All right. So the statute of limitation, 5 years. The borrower must bring action against the creditor for 5 years after the date of the violation occurred. 5 years. If there's a class action or a civil action being brought by the AG or the CFPB, any aggrieved person must join that action within 1 year. 1 year after commencement by the Attorney General or agency. All right, so 5 years on your own. If a class action or the AG or CFPB is bringing suit against them and you want to join that suit, you got to join within 1. Penalties for violations. All right, this is the first discussion scenario. We're going to see more and more of these throughout the 3 days. So we're going to read the bottom of 21 and top of 22. We're going to read what's going on here with big bucks lender, and we're going to talk about the ECOA violations. Did they mean to? Should they be fined? Does it matter? You know what? Somebody else asked me that, Jonathan. Where does the money go for the fines? It's how I get paid. It's how I get paid. No. Civil fines, I don't have any information where the money goes. I don't. And somebody else asked that. I meant to look it up, and been doing this a number of years, and somebody recently just asked that. I would say in the last month. Civil money and penalties and fines. I don't know where they put that money for civil fines. There's some other things we see later on that says, oh, the money goes to this, to pay restitution, but don't know. So we're reading the discussion scenario on page 21 and page 22, and then we're going to discuss it. Keep asking questions, Jonathan. Hopefully I'll be able to answer them more than not. Well, Mazel, if you don't have your ID, go ahead and check in again with your date of birth. You got to check in with something. Are markups legal? Markups are not a violation of RESPA, fee splitting, or kickbacks. That's what the Supreme Court said. They're not a violation of RESPA. Somebody said, are markups legal? The controversy comes in if they're not being split between two providers, then they're not a violation of RESPA. There are states that have, most states have rules that are called laws against unfair, deceptive acts and practices. All right, is it a deceptive act to tell somebody that their appraisal is $600 and it's only $450 and you're keeping $150? That's deceptive. So it could be an unfair, deceptive act or practice. I didn't say they were legal. I said they're not a violation of RESPA per the way RESPA is written as the way the Supreme Court. So that's what you want to know. The controversy surrounds is if they're not split, they're not a violation of RESPA. Oh, well, we'll get to that, Lacey. They're not even close to the same thing. A markup is when we mark up another provider's fee. We're marking up the appraisal. We're marking up the credit report. Those are things that we collect money from. My appraisal, my credit reports are $52. Let's everybody just charge 60. Just round it up to 60, and all that, every $8 that we get for every overpaying of a credit report will go to all the free ones that we run in files that we run all the time that never turn into loans. We'll offset that with that. That's a markup. That's a markup. All right, yield spread premium means I'm offering you a higher rate and I'm going to make more money because of it. I have to give you a credit for that money. All right. All right, so hold on. Okay, you bet, Lacey. So what are some of the steps originators can ensure we're not engaging in discriminatory practice? I just got an answer there, and that was from John Kearney. John says we should never refuse to take an application. All right, that's true. Anybody that wants to apply, let them apply. You can't discourage, even if you go, you know what, your credit report's 600 points under what it needs to be, your income doesn't count, you don't prove it on your taxes, and the borrower still wants to apply for a loan, let them apply. Take the application, we're going to run it through our system, and we're going to turn them down and send them an adverse action notice. All right, so the main way to not discriminate is treat everyone the same way and never refuse an application. There is one time when it's okay to refuse an application, actually two. One is the fact that somebody's underage, right? We don't have a lot of 17-year-olds trying to buy houses. I was in San Diego yesterday, and they did a loan for an actor, and the actor is underage. Well, the actor can't buy a house and go into contract, but their older siblings did, and the actor gave them the money, and it was a little weird deal. But if you're underage, that's not discrimination. You're not old enough to be in a legally binding contract. So other than age, what is the only reason that it's ever okay to refuse an application? Anybody? Anybody want to guess at that? Nope. There's one reason I said Lacey. Suspect of a crime. Okay. Suspect of a crime, proof of ID, i.e. fraud. All of those work into fraud. We know there's misrepresentation. We know they're committing fraud. Hey, man, we're not, it's really a rental property, but we want to apply for this owner-occupied because we can put less money down, get much better terms. All right? No, man. No, man, that's fraud. I'm not going to be part of fraud. You want to be an investor, be an investor. You want to be a speculator and a fraudster, go somewhere else. All right? Yeah. Illegal citizens, right? If we don't have a foreign national program, which most of us don't, some banks do, and they're not a resident alien, there's not many loan programs that would allow them to, but what we need to do is take that application and turn them down because of that. Doesn't mean we can refuse it. If it's not fraud, we should not refuse. If we take an application and through that process realize that they don't have a green card, they have a permanent resident alien status, I would complete the application, let them know, we don't really have a loan program for that. I'm going to take your application anyways, register it, and then turn them down. Then turn it down. All right? Here's what again, Dallas? All right? So, big bucks here. Is big bucks discriminating? Only 4.8% of their applications were secured by properties located in majority-minority census tracts. In their area where they do business, 38% of census tracts are majority-minority tracts. What if they're unemployed? Take the application, turn them down for no income. There's one reason to refuse an application, and that's fraud. Anybody else wants to apply, let them apply, and we'll turn them down. Well, what's your NMLS now, Dallas? We're doing NMLS this time, dude. Okay? Flordelizia Michael, just spelled interesting. And Nico. Flordelizia, that's a tough one for me, and I'm usually good with names. Michael Goins and Nico Grant. Check in, please, NMLS. Dallas, really, you're still telling me how you checked in after last week? We checked in with date of birth at 8 o'clock or 7 o'clock your time. At 9 o'clock your time, Dallas, we're checking in with NMLS. So send in your, there it is. I see it now. Sorry, buddy. All right. All right. So it's only okay to refuse an applicant. What if they're unemployed? Turn them down. Don't not take their application. Take their application, turn them down. You're whatever. All right. Most unemployed people will not apply for mortgages. I promise you. All right. If they do, let them apply. It's never okay to refuse an application unless we know they're misrepresentation or fraud. That's when we can refuse. Well, underage as well, but it's just, yeah, you can't take an application from an infant either, but I'm not going to mention that, all right? So underage doesn't happen, all right? How many 17-year-olds try to buy a house? Even if they, it just doesn't happen. It just doesn't happen. So it could be one, oh, they're too young. Yes, it's too young. So we can refuse. We can't do a loan for them. The main reason, other than underage, that we can refuse an application is fraud. Okay, so here we got big bucks, 4.8%. The DOJ says they denied the allegations. We never really deliberately discriminated against any individual group or area based on race or origin. They did, however, enter into a consent decree with the U.S. DOJ. It has provisions saying we are not going to discrimination. We're going to make sure we don't discriminate anymore. We're going to go out of our way to be more inclusive. We're going to take reasonable steps to ensure all creditor offers are made and marketed to everybody in our marketplace. So here's what we have a situation. Let's say the big bucks, they tried to open full-service branches 10 years ago in majority-minority census tracts. And because of property values, income, etc., they were not successful. They failed to make a profit. So they shut those branches and they opened smaller non-full service branches in those areas and only have the full service branches where they have the economic stability, the values, the income, and the clientele that will help them be a successful business. So does that mean they meant to discriminate and says, I don't want to do loans for those minorities or those people in those areas? Probably not. Probably not. But here's the deal. There's something that is called disparate impact. That your policy that you think is neutral actually had a negative impact on protected classes under ECOA. So it's called disparate impact. You didn't mean to discriminate, but your actions that you took actually created it really difficult for senior citizens to get loans from you. You really eliminated the entire minority section of your city by not advertising in that area, not going on Spanish radio if that's the case maybe. So what you did, you didn't mean to discriminate, but it had what's called a disparate impact. Right? Here's an example. I'm going to open up a mortgage company. I want you guys to come work for me. And the good news is we're only going to do jumbo loans. We're only going to do loans of over 417, or depending on our city, could be over 625. I don't want to mess with small loans. We're only going to do big loans. Is that a discriminatory statement? I'll do a big loan for anybody. I don't care what race, color, religion, sex, marital status you are, as long as I'm the jumbo expert. As long as you need a jumbo loan, I'm your man. Okay, fine. But who doesn't need jumbo loans? Who am I eliminating and saying I'm not going to help? Retired people, maybe single people because they're not dual income and they don't need a jumbo loan. Maybe I'm discriminating because they don't make enough money. Well, that could affect different ethnicities, or different parts of town may have lower incomes, and I'm eliminating that whole section of town, which happens to be a protected class. So I'm only going to do big loans had a disparate impact against people that are protected under ECOA. I could still be liable for violations of ECOA. Even though I had no intention to discriminate, my actions had a discriminatory or a disparate impact on someone who's protected under the ECOA. So that's kind of maybe what was going on here with Big Bucks. I'm sure Big Bucks wants to do loans for anybody and everybody they can, and they didn't mean to do such a poor job of that. But HMDA data shows us they're only doing 4.8%, so they're going to have to do some things to turn that around. That's part of their decree. I'm going to open a new branch here. I'm going to focus on, under this area. I'm going to advertise on different types of radio other than mainstream, more ethnic or more minority-based radio programming. We're going to run some ads there instead of just on, major hits radio or the home of the Broncos station or whatever. Those are disparate impact. All right, ECOA, Equal Credit Opportunity Act regulation. What? You better be fair and treat everybody the same. ECOA. All right. So we're done with RESPA for now. We're done with ECOA for now. And now we're going to spend the next few hours, even through and after lunch, we will not be done with the Truth in Lending Act. All right. The TILA is the biggest regulation that we have to cover. It covers a lot of stuff. All right. So right now, if you're starting to feel a little bit overwhelmed, or maybe just moderately whelmed, take a deep breath, newbies especially. All right, it's new language, it's new concepts. Just take a deep breath and just know that you're going to remember more of this at the end of the day than you think you are. Almost without doubt, I will tell you that is true. All right, we're hanging in there. I would love to go slower, but at the risk of not covering what, right? All right. Well, thank you, Pooja, Mr. Sharma, Miss, I don't know, Pooja. Very nice. Thank you. Thank you. I try to make you engaged, and I try to help you understand the concepts. I love instructing. Keeps me from having going to a real job every day. And all of you also got my bio. If you have questions about who am I, one of the things that shows, like the class outline has a bio on me and what I've done, and been in the industry since '86, always on the retail side, et cetera, et cetera. So it gives you a little information if you're curious about who the heck are you and why? How do you know this is the way it is? All right, so TILA, Truth in Lending Act. This is the oldest of our Consumer Credit Protection Acts. Since 1968, there has been the TILA. We call it TILA, T-I-L-A, Truth in Lending Act. All right, it's been around since '68. The purpose is threefold. The three main concepts. There's more to TILA than these three, but the three primary things I want you to remember is TILA drives a car, a C-A-R. TILA has a car. Her C, cost of credit, either the cost or terms of credit. TILA protects consumers, saying that all creditors must disclose the cost of credit. We use the same standards to calculate the cost of credit. We use the same terminology to show you what your cost of credit is, and we disclose it to the borrower in the same format. No matter what lender you talk to, you're going to get the disclosures of cost of credit in the same format, figured the same way, called the same thing. So you can compare. And we're going to go into what the cost of credit is. Don't you worry about it. So C, cost of credit. A, TILA, truth in lending. All credit advertising. TILA's A is advertising. If you're advertising and it has anything to do with credit, mortgages, car loans, real credit cards, Truth in Lending Act oversees that you are truthfully advertising. And if you use things that are considered trigger terms, which means it triggers the need for more information, that we use the proper disclosures clear and conspicuously to the trigger terms. So when we get to the section on advertise, we're going to break that down. Cost of credit, advertising, and the R in TILA's car is we have the right, in some cases, to notify our borrowers they have the right to rescind or cancel their transaction. When we do a refinance for owner-occupied borrower, they sign their loan documents today. They also get a 3-day right of rescission. We are not going to fund that loan tomorrow or today. We are going to fund it at earliest Friday. They sign today, they get 3 business days, Tuesday, Wednesday, Thursday. They have the right to cancel their transaction, rescind by Thursday. There's other things we're going to learn about rescission that some of us that have been in the industry a long time don't know. But her car, cost or terms of credit, advertising, and rescission. Those are the 3 main components of the Truth in Lending Act. TILA drives a car. All right? Who's in charge? The Bureau is in charge. The Bureau is in charge. What do we call it? This is the most common regulation letter that people refer to in our industry. It's called Reg Z. Regulation Z. Hey, did you send out the Reg Z notice? We used to have a TIL disclosure. It's now part of the integrated disclosures I mentioned we'll go through, but we used to have a separate, and what's called the TIL or the Reg Z disclosure. And how do we remember Reg Z? Well, it's truth in lending, and the TILA, truth, says in regarding to all these aspects, you must always tell the truth. You must tell the truth about all aspects of lending. Cost of credit, advertising, rescission, etc. You must tell the truth. Reg Z, telling the truth. So you get a question regarding Reg Z. What did we just violate here? And it's not telling the truth about cost of credit, advertising, or rescission. That's Reg Z because it says you must tell the truth, right? All right, that's the most important one I want you to remember. Of the regulation letters, the first 3, RESPA X, ECOA B, and definitely TILA Reg Z are the most important, in my estimation, letters that you remember. All right, so when does TILA apply? It applies when we have a credit transaction where we're offering credit to consumers and our company or person offers it regularly. It's not like, well, one time I'll carry paper for a guy that's buying a couch from me. No, we regularly offer credit, and it includes a finance charge, interest, fees. It includes some type of charge that's more than what the cost of the credit is. It's a finance charge, it's interest, or it's fees, and more than 4 payments. More than 4 payments with some type of finance charge, we're governed under TILA as long as it's back to personal, family, or household use. This is not for business credit. This is not for agriculture credit. ECOA covers all kinds of credit. RESPA and TILA are for only personal, family, and household use. RESPA is only on real estate. TILA's on all applicable credit, but we're really going to focus on what? Mortgage credit, because guess what? That's what we do. That's who we are. All right? So it doesn't apply to business, agricultural, organizational credit. There's an annual threshold. If we exceed that, which doesn't even ever come up again, to my knowledge, if we're getting you credit through the public utilities, we're getting credit extended with a broker through the Securities and Exchange Commission or something like that, there's a home fuel budget plan. Student loans, not under TILA, or you're taking a loan against your 401k, an employee-sponsored retirement plan, and you're taking a loan against your own money, not covered under TILA. Everything else is for personal use. You're getting a car loan, you're getting a credit card, you're getting a mortgage, you're getting a personal loan, you're doing a buy here, pay here at the furniture store. If it's more than 4 payments and they charge you finance, they're covered under TILA, installment loans. And then when we get to credit, we've got two types. We've got what we call closed and open-ended loans. An open-ended, closed-end loan means we're giving you all the money today. You're buying a car. I need $47,000 for my new pimped out ride. Here is your car loan. Here's $47,000, and you're going to pay us back over 60 months at 2.8% at $943 a month, whatever. That's closed. Don't ask for any more money. Don't ask for anything to change. That's the agreement we've got. We also have open-ended credit. In our world, we call it a HELOC, a home equity line of credit. And what it is, it's like a credit card, right? Credit cards are open-ended loan. Here's a $20,000 limit. You can use some of it. You can use all of it. You can use it all. You can pay it down. You can use it again. You can use it over and over and over and over. And your payment's based on what you owe. If you don't owe anything on your line of credit or your credit card, you don't have a payment, right? That's an open-ended line. All right, so we have 2 types, and we've got 2 rules. Both for disclosure, we're going to have slightly different rules, and for advertising, unfortunately, we have slightly different rules. All right, so bear with me because we're going TILA bit. We're going TILA hunting, baby. So a creditor, when I say it's covered under creditors regulated by TILA, it's either any natural person or any business or financial organization that regularly extends credit subject to a finance charge or payable under terms of a written agreement of more than 4 payments, or anybody that receives an initial payment on a consumer debt. All right. Regularly extend credit if it's secured by a dwelling, residential property, 1 to 4 units. Somebody's buying 6 units, not residential. All right, 1 to 4 units. If we do more than 5 in the year or any 12-month period, we've done 1 high-cost loan. We're going to learn about high-cost loans at the end of TILA this morning or this afternoon. And in any 12-month period, we've originated 1 or more high-cost loans through a broker. But in other words, we've done more than 5 loans in the previous year. So all of us, whoever we're working for, is going to be a creditor regulated by TILA under these guys, right? All right. So let's look at some definitions, make sure we understand. We're going to talk about finance charge. A finance charge is a charge that you're paying because you're financing something. And it is disclosed as a dollar figure. Your finance charge on this transaction is $34,916.17. A dollar amount. Highlight it. Your cost of credit expressed as what? A dollar amount. We're on the bottom of page 25. From the prepaid from finance charges, so we're going to charge a borrower closing a loan. We're going to charge them an origination fee. We're going to charge them a processing fee. We're going to charge them an underwriting fee. We're going to charge them a tax service fee. We're going to charge them PMI. We're going to charge them interest over the life of the loan and PMI with their payment every month. Those are all finance charges. But when we want to break it down to what we call prepaid finance charges, those are all the charges that are applicable at or before the loan's closing. So the interest over the life of the loan, the mortgage insurance we pay every month with our mortgage payment over the life of the loan are not, those are part of our finance charges, but they're not part of our prepaid finance charges because they're paid over the term of the loan, not upfront or withheld from the proceeds when we close the loan. That's a PFC, a prepaid finance charge, PFC. And with the prepaid finance charge, it helps us disclose to our borrower what an APR is. An annual percentage rate is our cost of credit expressed as a rate, annual percentage rate. It is not the interest rate on the loan. It can be, but very rarely. It is the actual total cost of credit. So what we do is we take the interest over the life of the loan and your upfront prepaid finance charges, and we calculate that. Well, your interest over the life of the loan is 4%, and you're paying $3,000 in prepaid finance charges. We're going to act like that was interest over this amount, and your interest rate's 4%. Your APR is 4.297%. It's always going to be slightly higher because it's not only just the interest, it's the interest plus the prepaid finance charges shown as if it were interest. So here's the thing for you newbies. When we do a no-cost loan, you hear a loan that's like, no closing costs, no cost. Well, it's not that the lender doesn't charge any cost. It's the fact that I'm going to give the borrower a higher rate and use that yield spread premium we learned around borrower credit. So here's the deal. I can give you a 3.75% 30-year fixed rate with $6,000 in cost. So that APR is 4.15. Just making this up. My APR is 4.15 and my interest rate is 3.75. Or I can give you an interest rate of 4% and pay all your finance charges for you, so your interest rate and your APR are the same, because I got enough yield spread premium to give the borrower credit for all their cost. And that's how we do no-cost loans. We give them a higher rate, creates yield spread premium, we pay their cost for them, and that's when the APR and the interest rate are the same. But in most transactions, the APR is higher than their actual interest rate because it's shown as the cost of credit, your rate plus your other cost as a rate. So if you're comparing loans, I can get 3.75 and $5,000 in cost, or I can get a 4% loan with $1,000 in cost, which is a better loan. Calculate the APR and see. That's the point of the APR, annual percentage rate. We've already defined closed-end and open-ended credit. We've already defined what a creditor is. All right, a charm booklet. We're going to see charm booklet a few times. The charm booklet stands for the Consumer Handbook for Adjustable Rate Mortgages, CHARM. And TILA says if you give them an ARM, an adjustable rate mortgage, you must give them a charm. TILA says if we give somebody an adjustable rate mortgage, we must, within 3 days of application, give them the charm booklet. It helps them understand the terms of an ARM, what it means, and the fact that there could be higher payments and not all rosy features. A lot of lenders like say, oh, it's a low rate and it's great and it's great and it's great. Well, what about the downside to an ARM? Well, we've got the charm booklet starting in 2007 that says, here's what you need to be aware of. An ARM gets a charm. When we get into our advertising, we're going to get trigger terms. There's only a handful of terms. If we say something in an ad that is a trigger term, it triggers the need for more information about that term. If I say, buy a house today with payments as low as $1,500 a month, guess what? $1,500 a month is a trigger term. And it triggers, well, how many months and what's the APR? What's your cost of credit as an APR and how many months? If I say $1,500 a month, how many months? What's my APR? It triggers the need for more information about itself. And those disclosures need to be clear and close and conspicuous next to the trigger term itself. We'll see it in ads, but people get this question wrong a lot in our little exam at the end, so I'm really backing up and making sure that we know what a trigger term is. All right, we're going to go through the loan estimate and the closing disclosure. New laws went into effect October of last year. Super important. Go through those in detail. We're going to define what an application is. An application is, and now we're right there. See that on page 26? Application. When we have a complete loan application, we now have the clock ticking. You got to get your loan estimate, you got your charm booklet. All of our disclosures that are predicated on a complete loan application start when we have 6 things. You have to have the consumer's name, Social Security number, income, address of the property, an estimated value of the property, and the loan amount. 6 items. Complete loan app. How do you remember that? Simple. Right next to it, right in that white space on page 26, write the word aliens down. A-L-I-E-N-S. Aliens. These are the 6 things. If you don't have aliens, you don't have a complete loan app. And you're going to want to know this. A, address of the property. L, the loan amount. How much is the loan they're seeking? I, income information on the borrower. How much money they make? E, what's the estimated value of the property? If it's a purchase transaction, we've got a sales contract for $550. Our estimated value is $550, and we're going to base everything on that. If it's a refinance, we may pull up some comps or run a computer model, something we call an AVM. It's like Zillow, but just way better. And from that AVM, we're going to say, oh, this house is, oh man, it's probably worth about $400. So I'm going to base my loan information on the value being $400. We have an E, an estimated value of the property. N, their name. S, their social. Alien. So if you get a question that says, we got this, this, and this from the borrower, what do we need to do next? Well, the first thing we need to do is find out if our aliens are in order. And if we only have an alien or an ELMS or something that's missing from the 6 items, it's not a complete loan app, and we don't put out the loan estimate form. We don't start giving them the disclosures. We're not required to, all right, until we have a completed. Nope. All income needed to be verified or stated, or does it matter? No, we have income information from the borrower. We may not have their taxes or W-2s, but we've gone through and we've put in something on our application about how much income they make. All right. Does this processor differ for refinances all? No, other than the value of the property is not a sales contract, we're going to have to ascertain the estimated value from an AVM or something like that. Okay, George? Right? Address? Yeah. We're doing mortgages. All mortgages are secured by a property. All properties have address. What's the address of the property that is going to secure the loan? If it's a refinance, we know the address. If it's a purchase, it's the property they're going to buy. So if we have a borrower, and we always, I preach as a loan officer, branch manager and retail VP, and doing all the training I've done in my life and doing a lot of loans I've done, I've always tried to get borrowers before they buy. Oh, you're interested in buying a house? Let's get your loan started. Let's get your loan completely approved. Then we'll sell you. Then we'll go get you a house with a realtor. Well, that borrower's not going to have the proper they don't know the address of what they're going to buy, and we don't know the actual estimated value of that property. We're going to get them approved in the $500,000 range, but my price may be $505 or $450. We don't know. So a TBD, to be determined on the property, is not a complete loan app. We don't have the address primarily of what they're going to buy. We're just getting the loan approved based on the fact they're probably going to buy in this $300,000 range or whatever it is. Okay? Everybody got that? Aliens. 6 items you have to have. Business day. Love it. Here's our first. Really? Really? Everybody repeat out. Really? There's 2 different definitions of what a business day is. My first, really. There's a few more. This term can be defined 2 ways. Complying with disclosure deadlines will require knowing which one we need to use. So the general definition given by the CFPB, and the general definition is what we use at application, up front. We've got to get our loan estimate and our certain disclosures to our borrower within 3 business days of a complete loan app. Well, what do we consider business days? Well, the general definition at application is any day on which the creditor's offices are open to the public for carrying out substantially all business functions. This definition applies to the deadlines for the loan estimate and our upfront disclosures. What days are mortgage offices open primarily to cover all businesses? Monday through Friday, not counting public holidays, federal holidays. Can we do business on a Saturday? Yeah. Can me and my processor go in and bank some stuff out on a Saturday and get some loans and get together and meet with clients? Yes, but is my company open for all its business? Is my underwriting department there? My closing department? My compliance department, right? Not there on a Saturday. So up front, we do not count Saturdays, Sundays, and federal holidays. So if I get the complete loan app on a Friday, I've got Monday, Tuesday, Wednesday as 3 business days before I have to get my disclosures out. I'm not going to count Saturday or Sunday as one of those, you got to get it out in 3 days. It doesn't say 3 days, it says business days. So up front, at application, don't count Saturday or Sunday or holidays. All right. The business day for the closing disclosure and for rescission notices at the end, we do count Saturdays. We just don't count Sundays and federal holidays. All right. Also, business days, we need to use that when we mail disclosures. Instead of handing disclosures or electronically transmitting disclosures, we're going to snail mail a disclosure. It's considered received 3 days, business days after we mail it. So if I mail your disclosures on Monday, Tuesday, Wednesday, Thursday, it's going to be received on Thursday is what we're going to go, and then we have other days we have to count. There's all kinds of days we count, but that's what we need to know. All right. So the deadline for a closing disclosure between the loan estimate and consummation, I'll touch that a minute. So a loan estimate form has to go out within 3 business days of a complete loan app. We get it out within 3. And then the next rule says the loan estimate has to be received by the borrower at least 7 business days prior to consummation. Kind of closing. So then we would be able to count Saturday, because anything having to do with closing or consummation, we count Saturday. All right, we're going to see this again. Just bear with me. It's a lot of information coming at you. And what is consummation? Not necessarily the closing date. Consummation is defined as the time the consumer becomes contractually obligated on a credit transaction. In other words, they go and sign all their credit documents for my loan today. They consummated the loan today. The loan, it may not close for a couple more days, and that's the contract. Closing is the contract between a buyer and seller. It's going to close by July 31st. Well, that's my contract with the seller to close the deal. I might sign my loans out at closing or before. It could be the same day. It doesn't have to be the same day. Consummation, different than closing. Most of us have always used the term closing. Now with this new world, we've got consummation all the time, okay? So what have we learned so far? Our annual percentage rate. Cost of credit expressed how? Say the words, annual percentage rate. So we're disclosing it how? Not as a rate, as a percentage. That's what I'm looking for, April, a percentage, right? An APR is an APR, yes, but it's a percentage, right? Does the 7 days start after the disclosure is received? Yes. Yes. For the day it's considered received, the next day is day 1 business day. Even if it's a Saturday, not if it's a Sunday. Okay? When we have advertising, what are the terms that we have in advertising that create an obligation for further specific information about that loan term? And that is trigger. That's right, trigger terms. And when we give somebody all their credit in one lump sum and say, that's it, you're done, that's what type of credit? It's not open, it's closed-ended credit. Closed-end credit. Good job. Good, good, good. All right, guys. All right, so let's get into stating the cost of credit. 2 uniform standards, the finance charge and the APR. They both include interest. I call interest the mother of all finance charge, and additional transactions cost. So let's first talk about the finance charge. Cost of credit expressed as a dollar amount. What's included in the finance charge? Any fee not payable in a comparable cash transaction is probably a finance charge. It's a charge because you're financing something. All right, I'm going to charge a loan origination fee. All right, is that a finance charge? Well, it's a fee you're paying to the loan company because you're getting a loan to finance the house. Would a cash buyer ever pay a loan origination fee? Would they ever pay interest? Would they ever pay mortgage insurance? Would they ever pay a lender's processing fee or a lender's underwriting fee? Those are payable by, that's something that a cash buyer would never pay. Ergo, more than likely, it's a finance charge. All right. The calculation or finance charge is a process that involves which of the many fees associated with a loan's origination or closing need to be included. All right, the APR. So it does include. So the finance charge does not include payable in a cash. Like we're going to establish escrow account. We're going to charge you 3 months collect 3 months for taxes, 2 months for insurance, and etc. Well, that's just a collection of money to pay later. It's not a charge. It's an escrow, not included. Do you think a cash buyer would want to have title insurance on their house to protect them, that whoever they're buying it from really is the seller, they have the ability to sell it, there's no other liens or judgments that could ever affect their ownership of that? Yeah, a title insurance would be something a cash buyer would pay. So on the left side is what's included. Anything pretty much attributable to a lender. A few things that lenders charges aren't finance charges. Notice the last bullet point at the bottom of not included. Everybody, what's not included in our finance charge? Appraisal and credit. What does a lender charge up front on pretty much every transaction that we ever done and we've done for my 30 years in the industry? Appraisal and credit. It's shown as POC, paid outside of closing. It's not included in our finance charge or our APR, even though we require an appraisal and we require credit. Why? Because I said so. Now, appraisal makes sense. If I'm buying a house for cash, I'm probably going to want an appraisal to make sure everything about the property I'm aware of and what other homes are selling for and how mine compares to those and when did they sell and how does mine compare. Smart buyer paying cash would probably get an appraisal. Cash buyer would never get a credit report, but it's not included. So title, etc. Pick up where we left off. Last break before we go to lunch, right? Time just flies by when you're having so much fun. See you back in 10. All right. If the amount is greater than the amount required to be disclosed, all right. So we could say it's more and we can come in under, but we can't say it's X and come in more than $100 over. If I say my finance charge is $1,000, it can't come in at $1,500. That would be a more than $100. And then if we have mistakes on our truth in lending disclosure now, on finance charge and APR, the borrower can sue the lender and get the loan rescinded, cancel the loan, rescind the transaction up to 3 years after the loan closes if there are mistakes made in the disclosures, one being the finance charge threshold and a few others. That can give a 3-year rescission. So our compliance people, the back-end people that are making sure that we're curing provisions and refunding money if we're over, and it's got, oh, we got to send them the $17. Well, if it's because we're going to be more than $100 off, yeah, we better redisclose or refund money so we didn't over collect. It's a big deal. Finance charge accuracy, $100. APR, cost of credit shown as how a rate, annual percentage rate. It's a very complex mathematical formula. We use an APR calculator, and our LOS, our loan operating systems, typically always figure this for us. We got to input the right information. Based on our information, loan amount, prepaid finance charges, term of the loan, etc., etc. It will calculate an APR. I am a finance guy. I'm pretty good at math. I don't know how and have never finished an APR. It's something you should never have to do, but we have to understand what goes into it. It's the loan cost paid in addition to the interest rate shown as a rate. I'm going to charge him an origination fee of $2,000, where we're going to consider if that $2,000 was interest, which it's considered interest. That's what we're doing, is we're going to say, well, your interest and your other cost equals this rate, APR. Well, so what's included in there? Our mortgage insurances, our PMI or MIP, our lender's points or discount points. Anytime there's a mortgage broker fee, definitely a finance charge or part of our APR. Originating, processing, underwriting. And again, title, escrow, notary, appraisal and credit, Repeat after me. Appraisal and credit are not part of our finance charges or our APRs. Even though they're lender charges, this trips people up. Not. And doc prep fees. Okay? Same school of fund charges, APR. So we've got different rules for different types of loans. It's not a very reliable estimation on an adjustable rate mortgage, right? Your interest rate's going to change every year for the next 30 years or so, but we're going to tell you today what your APR and finance charge are. Well, it's not accurate. It's based on determining factors we must use up front on an ARM, but over the life of the loan, that's going to change, so it's not reliable. Fixed rate should be extremely reliable. It's done differently on closed and open-end loans, and with your mortgage calculator, solve for rate using loan amount. Yeah, I know how to do it. Charles, thank you. I'm just letting people know you should never or will never have to be responsible as an originator how to calculate the APR. I've never been required, and the company's not relying on my calculation with my HP 12C of my APR to make sure the loan can rescind in 3 years. Because if we're off by more than 1/8, either higher or lower, the finance charge says we can't understate. The APR says if we come in 1/8 higher or 1/8 lower, 3-year rescission period. If it's a HELOC, an irregular loan, HELOC, 1/4. So my thresholds are $100 on the finance charge, 1/8% on the APR in a closed, and 1/4 on an open. That's fine. I can take a bad time, Charles, and that is how you do it, but that's definitely not part of this class. Just getting some people to understand what it is a good first step, right? I remember as a new loan officer, I was like, what? How do you explain that? How do you explain that? I don't get it. All right. And then, so we have to disclose those things. Disclosures on closed-end ARMs, right? Every purchase or refinance on a closed-end loan has to have a loan estimate and closing disclosure. If it's an adjustable rate mortgage, we give the borrower a consumer handbook on adjustable rate mortgages. It says it has to be done on owner-occupied primary residence. I think most of us just do it on anything, but the rule says if it's an adjustable rate mortgage on a primary residence, in other words, that's where they're going to live, we must give them a charm. And then we have a separate loan program disclosure for every loan ARM program we have. So we give them a charm, which is one charm, covers all ARMs, explains what an index is, explains what a margin is, ask your lender what their margin is. It explains how rates change and what the limits are and what that means. Our loan program disclosure, we have to give them a loan program disclosure for every adjustable rate mortgage with which they've expressed an interest. So if I talk to my borrower about doing a 3-1 ARM and a 5-1 ARM, I'm going to give them one charm booklet and one 3-year ARM disclosure and one 5-year ARM disclosure for every program with which they've expressed an interest. If it's an ARM, give them the disclosure. All right, and that became mandatory, the charm booklet, in October of 2007. And the goal is to educate consumers on the risk. Back then, we had a lot of lenders just advertising low start rates, low payment, payment's going to be super low for a long time, but they didn't say, but this is what can happen, and this is how bad it can get, and this is what you need to know about it. It was in their lending agreement, but people don't really read and understand their actual lending documents, so we created the charm booklet. Charm booklet, all right? So what does the disclosure say? It says, well, your terms are going to change, and this is the index and the formula that we used, and this is how your rate changes, and this is how your payment's determined, and this is what we add to the index. It's called a margin. You should ask about it. If the interest rate has a short-term discounted rate, you should ask about how long that discounted rate is good for. All right, and how often does it change, and what are the rules for the changing? Will my loan ever offer me a payment that's lower than my interest, which causes my mortgage balance to increase? That's called negative amortization. We'll learn all about that tomorrow. All right, this is how we calculate your payments, etc., etc. That's what our loan program disclosures give our borrower. It discloses all the particulars about that adjustable rate loan program. All right, so when borrowers decide and they take an ARM and then they close on a loan that has an adjustable rate mortgage, then the servicers, whoever's servicing, collecting payments on that ARM, have ongoing responsibilities to keep the borrowers abreast of when and how and why their ARMs are changing. So creditors and the loan servicers have obligations throughout the full term of the mortgages, especially when they choose an adjustable rate mortgage. So post-consummation, after the loan closes, we have ARM rate changes that we have to address. So there's what we call the rate and payment change disclosure and the initial rate change disclosure. So the two disclosures. The disclosure required is the rate and payments disclosure. That subsection D that only applies to the initial rate adjustment. The initial rate adjustment. That's the first time it adjusts. The initial rate adjustment. The first time it adjusts. All right. And then the rest of it, the initial rate adjustment disclosure and the rate payment change disclosure. Notice on page 34, on closed-in ARMs secured by a borrower's principal residence was when we have to do these. These disclosures don't only apply to creditors, but also anybody who is the assignee and servicers of ARMs. In the official interpretations of Reg Z, the Bureau notes that creditors, assignees, and servicers may decide among themselves which of them will provide the required disclosures. Oh man, I just dropped my book. I could own a loan. You could have closed a loan, and I bought it from you on the secondary market, so you assign that loan to me. But I have contracted with someone else to service the loan on my behalf. I own loans, but I don't want to service them. So I'm hiring Aquin, this huge servicing entity out there, to service my loans. So between me and Aquin, I'm going to decide who's responsible to do this. Typically, it's the servicer, but it could be any of the parties involved in that. All right. So if the loan has a rate and payment disclosure of 1 year or less, not required. Typically, less than a year is what we like to do. If we get back to the day where people have monthly or 6-month ARMs, not required. It changes so often, you should be aware your payment's changing because it happens every time you turn around. All right? And not required if the first rate adjustment is within 210 days of closing, consummation, and that actual amount was disclosed at consummation. It's not an estimate. Oh, after 6 months, your rate's definitely going to go to this. Well, you're aware it's less than 7 months, 210 days, and you know what it's going to be. No early payment notice given. All right? So what does the rate and payment change must provide? Everything to do with the loan. The explanation that your rate payments are changing, the effective date of when it's going to change. Anything else besides your payment that's going to change, we're going to describe it. We're going to give you a table showing your current and your new rates. Payments allocation fund. Here's what you're paying today. Here's what you're going to be paying next month. This is why. This is how the rate's determined. Every loan has limits or caps. Your caps are this, so if your rate goes above that, we're going to limit to this. We'll go through this tomorrow, newbies. We're going to have a whole section on ARMs tomorrow. So just nod and get used to hearing the concepts. If you don't fully understand adjustable rate mortgages, under general mortgage knowledge, tomorrow morning's program is where we go into those details. All right? How much are the limits? How is your payment determined? Is your loan allow for a small payment that will make your loan balance increase instead of decrease? Is there any prepayment penalty, etc.? And then we have the timing required. The timing, there's a bunch of different things on this page about timing. I lost my page. Sorry. There it is. 37, right? 25 to 120 day for grandfather. 25 to 120 day for frequent rate adjustments. All I want you to know, look on page 36, third paragraph from the bottom. In order to understand the reasoning behind the general rule and its exceptions, it's necessary to understand that the timing requirements for rate changes are based on our look-back period. The Bureau defines the number of days prior to the change date on which the index value, the interest rate, is selected is the basis for the new interest rate and payment. So, example, I've got a loan, a 1-year ARM, and my 1 year is up every September 1st. Every September 1st, I have a new payment. Well, they don't pick my interest rate on September 1st. They don't pick my interest rate on August 30th. They probably pick my interest rate back on July 15th. That's the look back period. July 15th from your change date is when we pick the index, and that index is 2.1%, and based on that, your new rate's going to be this, and your payment in September is given 45 days before that payment changes. So with a 45-day look back period, we should be able to give 30-day notice, 30 days notice. So all you need to understand about these 120-day advance notices has to do with how often the loan adjusts or how close or how far away the look-back period is. When do we choose the rate based on the index, and how far away from the payment, and how often? If you've got a monthly adjustable rate mortgage, which we don't really do anymore, but there could still be some out there from 10 years ago, we can't give you 60-day notice when your payment changes every month. The best we can do is pick it on the 5th or give you 25 days notice before it changes next month. That's the minimum. All right? So that's what it's all about. Timing. Look back period, how often does the rate change, affects your timing of the notice we're going to give you that, oh, by the way, your next payment's going to be blah. All right? Now, if we have loans with terms longer than a year, all right, we do a lot of hybrids. We do 3-1 arms. We do 5-1 arms. We do 7-1 arms. That means they're fixed for 3, 5, or 7 years before they ever adjust. And previously, we'd put somebody in a 5-1 arm, and we'd send them, 61 months from now, we're going to send them a payment. Oh, yeah, your payment went up $487. And people go, what? I can't afford that. I'm barely making it as it is. Oh, yeah, I forgot. I took a 5-1 arm out. So now we have 7 to 8 months, 210 to 240 days before the first payment adjusts to give them a little heads up, your initial rate adjustment disclosure. We don't know 210 to 240 days in advance of what that actual rate's going to be. The look-back period isn't 8 months typically or ever, but we do have an indication, and we do want to give them a heads up. Hey, next April 1st, your payment's going to change. Your payment and your rate's going to change effective April 1st of 2017, and it's going to be based on whatever the one-year T-bill is plus your 2.5 margin. Today's current T-bill is 2.2%. So that would be a 4.7% if it were to change today. It may be different because we're not picking it yet, but we're giving them an indication that, A, it's going to change, what the limits are, and what it is based on today's value. All right? We're going to give them the effective date, the explanation, and any other changes will be described to them. All right? Then we also have to, on that same notice, say if you have any information or any other questions or need any information from your creditor, here's my email address, here's our phone number, this is how you contact your creditor. If you feel like you cannot afford this change, you've got time to look at refinancing your house, you've got time to look at selling your house, you've got time to see if you can't afford or qualify for refinance, if we'll modify that loan to keep you from going into default. You maybe could short sell your house if you can't sell it, make enough money, maybe we'll agree to let you sell it, and you can pay us off less than what you owe us if we agree to it, etc. Alternatives. And here's a list of a couple of homeownership HUD-approved homeownership counseling offices in your area, and you can make an appointment and go speak to them to help get a better understanding if you wish. Those are the other aspects of our initial rate adjustment disclosure. All right, so that's ARM disclosures, both upfront and through the life of the loan. We have to continually let them know, don't forget your payment's changing based on this, this, and that, etc. If we're going to do a HELOC, a home equity line of credit, well, thank you, Nico, for sending that on over. Only check in when we ask for check-in information. Just, I don't know if people are out there stressing about checking in. We ask for it a few times a day. I'll let you know. We'll let you know. If we're not asking for any info, sit back, relax, and enjoy the flight. All right? Makes me nervous when I think people are nervous. Am I checked in? Should I be checked in? You'll know if you are. You'll know if you're not. Okay? So an equity plan, that's a revolving credit. It's like a credit card, but it's secured by a deed or a mortgage on your house. If you don't pay it to the terms, you could lose your home. All right, so it's open-ended like a credit card. It's got a limit, but we don't give you your $25,000 for your $25,000 HELOC. We give you a line of credit of $25,000, and here's a checkbook and a credit card attached to that line of credit, which is attached to your house, secured by your dwelling. And when we give the APR, we have to give it corresponding to the periodic rate, which is what is your rate that month. If it's a monthly payment, that means your periodic rate is your payment rate for that payment. So if I've got a 12% annual interest rate, my periodic rate is 1% per month. If I've got a 6% annual rate, my periodic payment would be 0.5% per month. That's what we have to use with HELOCs. We don't use them on closed-end loans, only on HELOCs. That's an interesting what? So when the borrower applies for a HELOC, they must just start disclosing things. If they apply through the phone or through a broker, then the disclosures, you get 3 business days to deliver these additional special. HELOCs have their own disclosures and their own forms. We don't use the loan estimate and the closing disclosure on a HELOC. They have their own forms. We don't use some of the other disclosures we give them when your home is on the line, what you need to know about home equity lines of credit. They can't pay any non-refundable fees until the borrower has received their disclosure. There are additional disclosures on HELOCs. And our HELOC disclosures must be clear and conspicuous and segregated from unrelated information. There's 4 separate disclosures that we only utilize on HELOCs. The first one is a disclosure telling you to keep your disclosures. Can't make this up. Retention of disclosures. You're going to be getting a lot of disclosures. You should keep those disclosures, read those disclosures, and understand those disclosures. Say disclosure again, Scott. Availability of disclosed terms. All right. Disclosure must explain the terms described or subject to change, and the loan applicant must submit an application to obtain specific terms disclosed, etc. Risk of losing home. It states that the creditor will now have a security interest in your property. You might have a first mortgage and they have a lien or security interest in your property. You're now getting another loan that is also secured by your property, which means you have the risk of losing the home. If you don't pay this loan, they can take your house. That's what a secured mortgage is. It's secured by your property. And the last one is there's unfavorable actions that are possible by your creditor. In certain conditions, they can take adverse actions, demanding outstanding balance in a single payment. You're 4 payments down. I want this thing paid off. Or, you know, we gave you this loan in 2004 on your house in Orlando that was worth X, and we gave you a line of credit this big. Well, your house is worth now a lot less, so we're going to come in and cut your line of credit because our position, our protection on your equity has been affected by the loss in value in the marketplace. That happened to me. Happened to a lot of people. You got a big old line of credit on your house based on 2005 values, 2008 values, certain parts of the country, not even close. We're going to cut your value. It could happen. Nothing that I did or you did, but it is considered an unfavorable action. All right, so disclosure statement must provide. Then we have to give them disclosures. Disclosures must give payment terms, APR, what are the fees associated with the use of the plan, what are the third-party fees required, is there title, is there escrow, is there appraisal fees, third-party fees, not our fees, does it allow for a payment that will allow negative AM, what are the other transaction requirements, and the tax implications. The thing that comes up with tax implications is this. Interest on a first and a second mortgage is typically tax deductible on a primary residence up to the value of the property. My house is worth $500,000 and I've got $500,000 worth of liens against it, and I live in that house. All my interest on those loans is tax deductible. If we go back to the wide world of crazy 2005 and I'm going to give you a loan up to 125% of your property value, that interest on the 25% of your loan that exceeds the market value of your property when you got it, right? I got to have $500,000 value. You gave me a HELOC up to $600,000. Any interest on that $100,000 over my value, not tax deductible. Understand it. Don't tell people that it is. So the Smiths are getting a HELOC. They get a written disclosure stating information about the loan. The disclosure tells them to keep a copy. informs them about the availability of the terms that are disclosed and how they can get them, and advises them the possibility the creditor can take unfavorable actions. Under HELOC guidelines, what other information should be provided to the Smiths based on the disclosures we just learned about? What did we miss? Anything? Bueller? Spicoli? Anybody out there? There we go. The risk, you have the risk of losing your home. Risk of losing your home is the other disclosure specific to HELOCs. Okay? Cool. All right. If it's a HELOC, it's an adjustable rate. Disclose, disclose, disclose. Your APR is going to change. It could include other costs. Your index is based on this. Your APR is determined with your index plus your margin, etc. The maximum APR that you could ever have. A historical example of what index your loan is tied to and how this loan has performed over the last 5 years. We're going to put your rate on every statement, etc. A lot of information there, right? I don't read a ton of bullet points. Then the creditors may not change the APR unless it's time for the index to change. They can't terminate a plan to demand advance payment or paying the loan off without reason, like fraud or foreclosure. They can't change any terms unless authorized by the borrower, and they can't change the index or the margin value unless the index that it's tied to no longer becomes available. Oh, we don't calculate that cost anymore. Oh, all right, we have to use something else. What can they do? Anytime the consumer agrees to a change, change it. Anytime the change benefits the consumer, you can do it. If it's considered insignificant, makes no difference what your payment is or certain anything important factors, or we can prohibit additional extensions. Now, no, we're not going to extend that loan. We want it paid off at the end of 10 years. We're not in the HELOC business anymore. We said 10 years. It's something like that, all right? Prohibitions and limitations. All right, so that's disclosures on ARMs and HELOCs. Charms has an arm. If it has an arm, give it the old charm. Now we're going to talk about rescissions, all right? New topic, rescission. What is a rescission? It voids a contract between two parties. We've already seen a couple 3-year periods. We screwed up our loan estimate. We screwed up our closing disclosure. Our finance charge is off by more than $100. Our APR is off by more than 1/8 on a closed-in loan. I can sue the lender and get my loan rescinded, don't have to pay him any more interest 3 years after I made the loan. It's a big deal. But all of us will be dealing with the 3 business day disclosure. When we're doing a refinance on an owner-occupied property, whether it's adding a HELOC, refinancing the first, putting a mortgage on a property that's paid off free and clear. In other words, the borrower already owns it. They're already entitled, and they live in the house. It's their principal dwelling. Any loan we do must be given a 3-day rescission. All right? Unless it's a purchase or construction, because they don't already own it. You're purchasing or constructing it. We don't give them a rescission. We have to give them the closing disclosure 3 days before they consummate the loan, and it's not called a rescission. Or if it's credit by the creditor that made the original loan, and they're refinancing the loan, and they still hold the loan in their portfolio. They're servicing the loan. So I work for Wells. I originate the loans through Wells. We close the loan through Wells. Wells is servicing the loan. If I want to refinance the loan through Wells again, they don't have to give me the 3-day rescission period. A caveat, exception. You're dealing with state agencies. They don't do many refinances. Or it's a series of advances, not the original loan closing, or optional insurance products that are not PMI, hazard insurance, and flood insurance, which are required by the lender. Then we don't have a rescission on those. But basically, an owner-occupied refinance or adding a second mortgage to a home that the borrower lives in requires a 3-day rescission period. All right. So we have a rescission notice. We have 2 rescission notices that we give to every borrower and any party with an ownership interest in the property. So I've got a husband and wife refinancing their house, and we get the title information, and we see that there's somebody else on the title. It's her mom. She's not on the loan. She's on the title of the property. Maybe she gave them the money to buy it in the first place or whatever. We would, when we go to close that loan, we would give the husband 2 copies of the rescission notice, the wife 2 copies of the rescission notice, and we got to make sure that the mom gets 2 copies of the rescission notice. 1 copy is for each of them to sign saying, I have received a copy of this notice. And then we take that and we put it in our loan files showing every party with an ownership interest acknowledged and knows they have a rescission period. Then they keep one. And there's another line that says, I hereby cancel this transaction. And it explains the lender has a security interest, the right to cancel or rescind exists, and this is how you do it, the date the rescission expires, and the description of the effects of rescission. All right, and it's a 3-day rescission, and we count Saturdays. Saturday on a rescission, Saturday on a closing disclosure is no different than Tuesday. At the end, if there's a rescission or a closing disclosure time frame, we do count Saturday. Saturday is just like Tuesday. All right, so if I sign my loan on Wednesday and I get my rescission and I sign all my documents Wednesday, my 3 business day rescission would be Thursday, Friday, Saturday. It expires at midnight Saturday. I could fund that loan first thing Monday morning if we came into the office and did not have a signed rescission received from the borrower, emailed or stamped, fax stamped or whatever, by midnight, 11:59 and 59, that's Saturday. That's my 3rd day. If I sign a loan on Tuesday, Wednesday, Thursday, Friday, expires midnight Friday. In the exam world, we could fund a loan on Saturday. We don't. But in exam world, what's the earliest day that loan could fund? Saturday. Why? Because Saturday is no different than Tuesday when it comes to rescission rules. Okay? Count Saturday just like it's Tuesday, whether it's a day, the 3rd day, the 1st day, or the day the loan can fund. If it's Saturday, it's Saturday. Okay? A lot of us, we of course won't fund that loan till Monday. What's the earliest it could fund? Saturday. So that's what a rescission says. Everybody that has ownership interest must get 2 copies. All right? It's the latter, and the rescission starts the day after consummation or the notice of rescission or all the other material disclosure, which is the last. Typically, it's all done on the same day. Here's your lending consummation. Here, sign all your loan documents. Here's all your material disclosures. And here's your rescission notices, all in one big old fat package that they're all signing on the same day. Boom. That day is Thursday. Rescission starts Friday, Saturday, expires midnight Sunday. The loan can fund and disperse on Tuesday. All right. If it's an open-ended loan, same kind of thing. 3 days after the credit plan is open, the security interest is added or increased, credit limits increased, delivery of notice of right to rescind. The latter of all those things, usually they're typically done all on the same day. But the latter of any of those things, that day is Tuesday, then Wednesday would be day 1 of rescinding. The day that they sign or get the documents is not the 1st day. I just said that, didn't I, Matt? No, it is not possible to count the day of signing as day 1. Not in the exam world, and I think not at all. If you sign on Monday, day 1 is Tuesday, and etc. Okay? Exercising right to rescind. They must provide written notice before the deadline, and the deadline is printed right on the rescission notice. Now, any party with an ownership interest may rescind. We had 3 people that got rescission notices. The mom, the mother-in-law, she could go, oh, you silly kids, you don't want to refinance and start over on this. I don't think that's a good idea. She could sign her rescission notice, send it to the lender, and the husband and wife would have no idea, and we would cancel the loan right there as it sits, because any party with a rescission interest can cancel the rescission without regard to the other parties. You got 3 people with a rescission. We don't need 3 rescission notices. We need 1, and 1 is it, and 1 is done, and the deal's done, and that loan is rescinded. Any party, 1 of them, can rescind without talking or caring about, because I've seen these situations happen. Okay, here's, ow, that's a pain. Stories. I get a call from a borrower, one of my loan officers in one of my retail branches in Florida. Hopping mad, right? Complaint calls go uphill. Hop and Matt, why in the blankety blank blank did you people send my sister information that we're getting in the loan? Well, I got the information here, sir. It looks like your sister's on the title with you. She's not on the loan, I understand that, but she is on the title of the property, and Truth in Lending Act says that we have to notify everybody that has a right to rescind. This is an owner-occupied refinance, so your sister has ownership interest, and she has the right to rescind. She has ownership interest in the property, therefore she needs to be aware of what's going on. That's the regulation, that's the law. And I see here that she got her rescission notice, and it took her 0.3 milliseconds to rescind. And the deal's done. Why? Well, they own the property through inheritance, and the brother and the wife lived in the house, and they thought it was a good idea to refinance and take a big old chunk of cash out. And she was none too happy with him taking cash out of her property that she owned half of without talking to her about it. So there's your example to remember. All three get rescission notices, 2 copies. Only one has to rescind. All right? What is a rescission? It goes through this stuff that the lender no longer has a security interest. We'll have to correct public records. We have to return fees in 20 days. The borrower has to return any funds. You got to be some kind of special person, special mortgage company, to fund and disperse funds and do public records before the rescission period is up. Right? What we do is we sign our loan docs, and you give the rescission notice, and we sit back and do nothing until that rescission is up. When that rescission is up Thursday night at midnight, we come in Friday, see the loans rescinded, it's scheduled to fund. Now we're funding and wiring the money to the title company. Now the title company is going to go and secure our property with public records such as a mortgage or deed of trust. Now we're going to collect fees from the loan disbursements for the borrowers, and they're going to get their check if it's cash out. We would never do it before. I don't know what bizarro world these people live in, but that would be the consequences of rescission. But that should never happen because we aren't going to fund a loan. I can just see Lloyd and Harry getting their check for a cash out refinance, and then of course spending it all, and then changing their mind 3 days later and rescinding us and giving us a whole bunch of IOUs. Better hold on to these. These are pretty valuable, but we spent all the money, but then we changed our mind. We didn't want the loan after all. We would never do that. So it would never happen this way with these consequences, but that is what the consequences would be if somebody was not making prudent decisions. Okay? A borrower has the right to request that we waive the rescission period. Most originators, all my old-timers, bank people out there, have you ever recommended or got a rescission period waived on a refinance? I'm betting that's 99.9746% never. Thank you, Charles. Never, nope. No way, no how. Didn't know it could even be done. Exactly. Because no good deed ever goes unpunished. As soon as we waive a rescission, and it has to be in the borrower's own writing, everybody who has the right to rescind has to sign the explanation from the borrower in their own words of their bona fide personal financial emergency. Describe the emergency. All parties with a right to rescind must agree, and then the lender would have to go, you're right. Your mother really will, they really are going to turn off life support for your mom if you don't pay the hospital bill before that. That's a pretty big financial emergency. Sure, we'll waive it. Of course, that is not a thing, and there's not many things that I would say that I've ever waived it for. Ever. So it can be done. It's possible, just not very probable. All right? And then what happens? Then how do you turn 3 days into 3 years? Well, you screw it up. So if we don't give everybody with ownership interest in the property 2 copies of the rescission notice, and they realize, or their attorney realizes it, they're going to rescind that loan up to 3 years later. So we screw up the 3-day rescission, turns into 3 years. We screw up our TIL disclosure, our APR, our finance charge. There are other things on the TIL that could lead to misinformation that would give you a 3-year rescission. So only TIL material disclosures or screwing up the rescission for the 3-day begets a 3-year rescission. Measured from the date the loan was consummated, and it will expire in less than 3 years if the borrower transfers their interest in the property or sells the property. You don't own it anymore. You're not on title anymore. You can't come after us for a 3-year rescission. You still own the house. You're still on title. And what does every attorney in America ask any borrower that sits down looking at foreclosure challenges or bankruptcy challenges that has a house? How long have you had your current mortgage? When did you buy your house? When did you get your loan? When did you refinance last? Less than 3 years? Perfect. Bring me all that documentation. I'm going to sue the lender and tell them we want to sue for a 3-year rescission. We're going to make them prove and find any little mistake they might have made to get this loan rescinded. What? Yes, that's what I said. It's a big deal. It's a big deal. And extended right of rescission, right? So we got the 100, 1/8 to 1%. Accuracies for refinancing that is not involving a high-cost loan is a little bit different. If there's a foreclosure finance charge, can't be understated by more than $35. So you got to borrow in foreclosure. Now our understated $100 just went to $35. So we will double, triple check our math and our figures extremely accurately when we close the loan and after we close the loan, and probably the investor that we sell the loan to will double, triple check that those disclosures are right again. Otherwise, we'll fix them or refund the money. Nope, you're good. All right? Greater than, that's special rules for 3-year rescission. Okay, that's our rescission information. Right, everybody good on that? All right, let's switch to TILA's advertising prohibitions and rules. So credit advertising is all governed under Truth in Lending Act. Reg Z creates specific prohibitions on what we can't do at all. And there are trigger terms. If we say this, you must give them information explaining this is that. And there are separate rules for HELOCs and credit cards as opposed to car loans and mortgages, open versus closed-end loans. All right. So if we're going to advertise open-ended loans and anything in our ad discusses finance charge, a late payment, title, appraisal, credit report fees, taxes on the transaction, or payment terms on the home equity plan, those are trigger terms. They trigger the need for more information. The finance charge triggers that we have to explain any fee that's a percentage of the credit limit that's considered a finance charge is this. If we talk about late payment, title, appraisal, credit, then what are the dollar estimates of those fees required to open the plan? If we talk about taxes imposed on a credit transaction, any periodic rate for the finance charge calculation, and anything to do with payment terms of the home equity plan, we would disclose the maximum APR. So the top section is the trigger terms. The bottom sections are the disclosures required. Where the disclosures need to be. I call it, there's 2 C's in the book, I use 3. They need to be clearly stated, close in proximity, and conspicuous in size. In other words, no fine little mini print on the next page. Clear, close, and conspicuous information related to the trigger term itself. Not disclosures about the whole loan program, just the trigger term. You said the payment, what's the maximum APR? And probably how many payments. Well, if it's an open-ended loan, there's not how many payments. It's open. It can go forever. Right? If it's a closed-end loan, we would say how many payments? 180 on a 15-year, something like that. Okay. If we're offering a short-term discounted or premium rate, credit card, 0% financing for the first 6 months. I know we don't do credit cards. It's an example we all see. That initial APR is not based on any index and margin, right? It has nothing to do with the index and margin. So then if we give 0%, we have to tell them how many months that's in effect and the reasonable APR if it were fully indexed. What is the fully indexed rate? If my index is prime rate and my margin is 6, my fully indexed rate is prime plus 6, which is, I don't even know what prime is, blah, blah, blah. Right? So we would have to tell them that we're giving you 0 for 6 months. After 6 months, it goes to whatever this is. Today, this is this. That's discounted in premium rates. If we're talking minimum payments, then if it's a HELOC, a minimum payment may require a balloon payment. A balloon payment is any payment that's more than twice the amount of a normal payment. Typically, a balloon payment says we have to pay the whole balance off now. I'm going to give you a 30-year loan payment, but I'm going to put a 10-year balloon. You can make payments based on a 30-year amortization for 30 years, but in 10 years, I want your loan paid off in full. That's a 10-year balloon with a 30-year amortization. We call it 30 due in 10, or a 10/30, something like that. But on an open-ended line, credit cards don't have balloon payments because there's no end date. Your credit card expires 10/18, but what happens in 9/18? If you're in good standing, they send you a new credit card. It's not ever due and payable. Credit cards go on forever if you remain in good standing. However, a HELOC could be a home equity line of credit, an open-ended line, but it may only be for 10 years. And what happens if you make the minimum payment, or the last few years before your 10 years is up, you go out and charge the thing up to its max, and you haven't paid it off at 10 years, time's up, you're going to have a balloon payment due. So we would have to state that. That's why we're getting at that balloon payment. You can make all your payments on time, but because of the way you used it, made minimum payment, and maxed it out in the 9th year, at the end of 10 years, we're not willing to extend it. You're going to have to refinance or pay it off. That's a balloon. We can't use misleading terms like tap into your free equity or, free immediate approval. Those are misleading terms. How do we know you're going to get immediate approval? We don't know anything about you. We can't advertise that. It's not free money. It might be your equity, but it's not free. We're going to charge you fees and interest to get to it. So there's those misleading terms. We still see them. Most of them are now illegal, but so is driving 60 and 55, and people do it all the time. It just depends if they get caught or not. People do 75 and 60 all the time. They're more likely to get caught, but they do have to get caught before they get pulled over. Same thing with people who violate TILA. All right, so people say, well, I see this all the time. Doesn't mean it's not illegal. And you can't talk fixed APR unless you say fixed for how long. All right, always fixed for how long? Fixed for 30 years, fixed for 60 months. Rate subject change after, something to that effect. If we're offering those promotional rate and payments, and this is an example that we really don't have anymore. Like I know that the time period, we've got a 2-1 buy down. I'm going to give you 5% for the first year, 6% for the second year, and 7% years 3 through 30. I would have to say the time period for the 5% is the first 12 months. The time period for the 6% is the second 12 months. And the 3 through 30 is going to be 7%, and the overall APR would be, I don't know, 7.134%. We have to give the amount, the time, each simple payment, and the overall APR. If anything is stated about finance charges or any other fees, what's the dollar amount of those fees? And if what's the periodic rate on a HELOC, and what is always the maximum APR? Promotional rates and payments on HELOCs. Closed-end loans. We have 4 different trigger terms. One is the amount or percentage of down. Refinance today is a little, or buy a home today is some without 10% down. Well, that's 10%. Well, how much is that? $10,000 on a $100,000 purchase transaction. Amount or percentage of down requires a statement of the amount or percentage of down. The opposite. The number of payments or repayment period. We must state the terms of repayment through the full loan term. If we ever talk about payment amount or finance charge, the APR and whether the rate will increase after consummation. If we say fixed for how long, and the fact that that rate's subject to change at that time, and it will go up, subject to increase. An ARM may not go up. It's more than likely going to go up. There are some bizarro situations, especially in the mid-2000s, that we did ARMs on the 10-year ARMs and 3-year ARMs and 1-year ARMs and 3, 4, and 5. Those rates went down and are still way less than they ever started at because of what happened in the interest rate market. That's the rare time in history that that's happened. Typically, ARMs go up when they start adjusting. They don't have to, but we have to let them know that they can potentially increase. So, on a closed-end loan, the amount or percentage of any what payment is a trigger term. What did we just show that was? Amount or percentage of any, not an up payment, but a down payment. Amount or percentage of any down payment is a trigger term, and we have to counter with the percentage or the amount of down, unless it's 0 or 100. If we advertise 100% financing, we do not have to advertise 0% down. If we advertise 0% down, we do not have to advertise 100% financing. But anything else needs to be done. What charge is a trigger term both on HELOCs, closed and open-end loans? That's right, gang. The finance charge. The finance charge. Advertising a minimum periodic payment triggers on a HELOC that what may result? If I've got a minimum payment being made on a HELOC, what may happen at the end? You have to pay it all off. What do we call it? That's it. A loon, a naloob. Nice typing, but yes, a balloon payment may result. Okay? So I already did this. If an ad states a simple rate of interest and more than one rate applies, like a buy down, we have to disclose the simple rate, how long, for each period of time, and the overall APR. If an ad states the amount of any payment, if we ever advertised, and sometimes I hear builder ads. I've seen builder ads over my years in the industry. You know, buy a home today for as little as $1,800 a month. All right. Well, how many months, amount of time the payment's going to apply? The period of time each payment will apply per month, if it's per month, which we always do monthly mortgages, and the fact that that payment we included or we're quoting does not include taxes and insurance. And what's not stated here is the blinding flash of obvious, and that is the APR. We can never quote a payment without quoting APR. APR, how many payments, and the fact that if it's a first mortgage, the $1,800 a month does not include money set aside for real estate taxes and homeowners insurance. I've heard that in the last year or so. There was a builder advertising stuff around here, and I heard it. I'm like, oh, look at them doing their trigger terms and doing the proper disclosures for trigger terms. Okay? If an ad states that a loan may exceed the market value of your property, we don't want to confuse them and let them think that what? They can deduct the interest on the amount that exceeds. Consult your tax advisor. All right. Then we had a lot of stuff going on in the mid-2000s. We had a lot of new loan products. We had a lot of borrowers that were confused, some that were duped, some that were tricked, some that didn't care. But whatever the case, we had one heck of a mess at the end of the day. And in 2008, the Federal Reserve Board said, you know what, we're looking at this, and I think these mortgage ads are pretty confusing, and people are really getting away with stuff. They're misleading the public. So they came up at the time. The Federal Reserve had a lot of oversight with TILA. It was before the CFPB. We're going to see later today, you know, the CFPB hasn't been around for but about 5 years. So before that, we had a lot of these regulations since 68, since 74, et cetera, et cetera. So there were other agencies in charge. The Federal Reserve came up with 7 prohibited practices when advertising closed-end mortgages. They said closed-end credit secured by a dwelling. Well, any credit secured by a dwelling is what we call a mortgage. We're in the mortgage business. We're not in the closed-end credit securing dwelling business. We're in the mortgage business, whether we do deeds or mortgages, right? So they said there's 7 things that you can never misrepresent anymore. They were adopted by the Federal Reserve Board and revised Reg Z in 2008, and based on studies of advertising copy that allowed the Reserve to identify misleading and deceptive practices. The following are the 7 prohibited. Misleading advertising of fixed. All right? We used to have 1 month ARMs that were neg-am. Fixed rate at 4.5%. It was fixed for 1 month. It was fixed for 3 months, and that they would advertise it as a fixed rate. So we can no longer use the term fixed rates in payment. It's prohibited unless there is conspicuously and equally prominent information about it also changes when it's going to change and your payment's going to increase. Refinance today and save $300 a month. No. Based on what? Refinance today and save $300 a month based on a $300,000 mortgage amount with a 2.375% APR for 360-month closed-end mortgage, then maybe, but not just saying refinance today and save. This is a big one. People say they still see it. Misrepresentations about government endorsement. We're fully approved by the federal government to come in and save you hundreds of dollars a month. We've got a special government program approved by HUD. Yeah, you are doing FHA streamlines, but there's no government endorsement. There's no special government program. You cannot make any misrepresentation that lead consumers to incorrectly assume that this product is special to you or specially endorsed for you by the government. Kind of funny, I see on my email feed, because I do a lot of searching and reading about mortgages and people going to jail and changes in the law and what's going on in our industry, I get all kinds of mortgage ads. Obama's refinance plan. Obama wants you to refinance. Obama wants you to, that's skirting the rules of the government refinance plan. There's no Obama or government, but I see it every day and I want to flick them right on the ear. Right? No government endorsements. I used to get this when I was in Orlando all the time. We owned a number of properties. Contact me immediately about your loan with Pinnacle Financial. Well, I do my own loans through Pinnacle Financial, and I also have a whole marketing plan for every closed loan that we did through Pinnacle Financial, and it's not for me. And then I'd have clients call our offices like, well, I got that information you sent, or clients call complaining about the horrible service they received when they contacted about that thing from Pinnacle when it was never from Pinnacle. So you can't use the government or the lender's name if you're not the lender. It's public record. Ooh, Chase did a bunch of mortgages. Contact us immediately regarding your Chase mortgage. No, violation. Refinance today and eliminate all your credit card debt. Lower your payments and eliminate that high interest debt. We're not eliminating debt. We're restructuring it from credit cards to your mortgage, and it may be a lower interest and tax deductible and save high credit users thousands, hundreds of dollars a month till they go out, of course, and recharge those credit cards up. But we're not eliminating it. Now, if you want to write a check and pay off your consumer's debt, then you're eliminating debt. If we're just putting it on another loan, you can't say debt elimination. We can be a consultant, and we can counsel people on what loans is best for them, looking at the short-term financial goals and obligation compared to their long-term aspirations. And we can do all that, but we can no longer call ourselves a counselor. With the advent of homeownership counseling services that are available out there that we have to recommend our borrowers go to, not require except for in a few situations, we cannot call ourselves counselors unless we work for a non-profit. So if you get paid for doing loans, you are not a counselor. You can counsel and you can consult and you can be a mortgage consultant, but you cannot be a counselor anymore. And we cannot advertise the trigger terms in a foreign language and then come back with the disclosures in English or any combination thereof. All right? Some target immigrants who lack fluency in English by using favorable lending terms in the first language and the information about the trigger terms or the disclosures or the less favorable terms in English. All right, you're going to advertise the good stuff in Portuguese. All the other stuff concerning those terms and that advertisement must be also available in Portuguese or any other language. 7 deadly sins of mortgage advertising per TILA. Liability and penalties exist. Violations of TILA may lead to criminal liability and penalties, which are addressed in the law. Civil liability penalties, which are addressed in other parts of the law. When can you have criminal liability? That may arise from willfully and knowingly violating the law. You know you're violating the law, and you're doing it on purpose because you want to not tell people everything they need to know. You're not going to tell all your borrowers that you're screwing over that they actually can rescind in the next 3 days. We're just going to hold those rescission notices out. I'll count 3 days. Then we'll fund your loan. Then I will forge those rescission notices, and I'll put them into the file on all the people we took advantage of. That is willfully and knowingly, and it's criminal. Giving false or inaccurate information, failing to provide information that the law or regulations required to be disclosed, or using the charts and tables that the Bureau has authorized to determine and disclose APR and a matter to be inconsistent, to actually understate and lie about that information. Okay? Criminal. In addition to specific violations that may result in criminal liability, TILA includes a broad statement creating criminal liability for willing and knowing violations of the law. Penalties for criminal liability can be up to only $5,000. You go to $10,000 for paying or accepting illegal FORO fees. $5,000 for willfully and knowingly violating TILA and quoting things to your borrower. All right. So penalties criminal may include fine, imprisonment for up to 1 year, or both. Fine, imprisonment. Civil liability. TILA contains numerous provisions that relate to civil, individual actions for TILA, and that's lunch, 400 to 4,000, 1 million to 1% of class action. Thanks, Scott. You're missing. All right, Lacey. Thank you, guys. All right. So you didn't go to my first class, guys. Our lunch break is an hour. That was my alarm for lunch. We'll see you back in an hour. Remember to print out. This is a good time to print and find your practice questions. There's 90 for today. There's 35 for tomorrow in the morning, 40 in the afternoon, something like that. It's a big packet of practice questions. Print them out. We're going to need them later today. All right? See you back in 1 hour for lunch.